Wait for the hearings team to start the live stream before we begin. Okay, good morning and welcome to the Office of Tax Appeals. My name is Sarah Hosey and I am the lead administrative law judge for the hearing in this appeal of Peak Travel Group and R&L Peak. With me today on the panel are Judge Amanda Vassie and Judge Eddie Lamb. The Office of Tax Appeals will be conducting today's hearing electronically with the agreement of all parties and participants. Also present is our stenographer, Ms. Alonzo, who will be reporting this hearing verbatim. To ensure we have an accurate record, we ask that everyone speak one at a time and do not speak over each other. Also, speak clearly and loudly. When needed, Ms. Alonzo will stop the hearing process and ask for clarification. After the hearing, Ms. Alonzo will produce the official transcript, which will be available on the Office of Tax Appeals website. Today's proceedings will also be live streamed. The transcript and video recording are part of the public record and will be posted on our website under hearings. During today's hearing, OTA asks that you please mute your microphone if you're not speaking to avoid feedback and background noise. If there are any questions during this process, please direct them to me. If we become disconnected or have technical difficulties, please wait. We will contact you. We will go off the record and take a break, and then we'll get reconnected. The Office of Tax Appeals is not a court, but an independent appeals body, which is staffed by subject matter experts and is independent of any tax agency. OTA does not engage in any ex parte communications with either party. Our decision will be based on the arguments and evidence provided by the parties on appeal in conjunction with an appropriate application of the law. So right now we're just off the record. I'm doing a bit of review so we can go over what was discussed at the pre-hearing conference, go over our exhibits, set up a witness order, and answer any questions for everybody so we're on the same page. Then we'll go on the record where we'll have your introductions, witness testimony, and your presentations. So if at any time you're confused as to our timeline or any questions, just please feel free to ask me. So again, I'm the lead judge for the purpose of conducting this hearing, but all three judges on the panel are equal participants in deliberating and determining the outcome of this appeal. So any member of the panel may have questions for the witnesses or representatives during the hearing. We have all read the briefs and examined the exhibits provided for this appeal, and we're looking forward to the testimony and arguments today. So as for the issues today on appeal is whether Respondent Franchise Tax Board erred in assessing additional tax based on the built-in gains from the sale of Peak Travel Group. And issue 2 is whether FTB failed to adjust the gain from the installment sale of Peak Travel Group assets. Mr. Mather, does that sound accurate today?
Yes, that's right.
Okay, thank you. And then Mrs. Kudik, does that sound accurate?
Actually, no. It doesn't reflect that appellants have the burden to establish that. So my issues are whether appellants have established that respondent erred in assessing additional taxes based on built-in gain, and then whether appellants have established that respondent failed to properly tax the gain from the distribution of PTG's contingent payment obligation.
Okay, I can restate those based on the burden of proof.
Mm-hmm.
Okay, moving on to our exhibits. I'm going to start with appellants. We initially had a submission from you, exhibits 1 through 15. And then Mr. Mather, I saw that your recent submission states exhibits 1 through 10 reference FTB's lettered exhibits. Did you want to relabel exhibits 11 through 15 as 1 through 5, or did you just want to keep them as 11 through 15?
I submitted copies that were marked 11 through 15, so I'd like to leave it like that.
Okay, that's fine. Just wanted to clarify. Mrs. Kudik, did you receive that?
I'm sorry, to the extent that it matters, I just, the FTB exhibits are also our exhibits as well. So
Yes.
that's why I numbered them with the continuing sequence. I didn't want to be confusing at the hearing whether we're talking about R2 or FTB's B. So I just deferred to FTB's lettering.
Okay, that works. I notified the panel this morning as well, so we're aware of the lettering and numbering. Did the Franchise Tax Board get the recent submission with 11 through 15, Mrs. Kudig?
Sorry, I had to unmute. Yes, we did.
Okay, were there any
That was 11
objections to
through-
these? Oh, go ahead.
Yeah, we have appellants have 5 exhibits, 11 through 15, and then we have exhibits A through L.
Yes. Did you have any objections to the appellant's exhibits 11 through 15?
I don't think we have any objections, but I was wondering the last 2 exhibits, they were not put in the record in a timely manner. Is that correct?
Oh, you mean submitted by the,
Yeah, by is it November 8th date?
yeah, I think they
Yeah.
were received on the 7th, but then input on the 8th. Is that right, Mr. Mather?
Yeah,
Mather.
they were timely.
Okay. I mean, we don't have any objections because,
Okay.
but I just wasn't sure if they were timely.
Thank you, Mrs. Kudik. Okay, and then, so we'll submit those, or admit those records shortly. And we admit those exhibits into the record shortly. All right, and then for the Franchise Tax Board, we have, A through J initially, and then we had K and L submitted last week. Mrs. Kudik, is that accurate?
Yes.
Okay. Are there any objections to those exhibits? Mr. Mather?
No.
Okay, we will admit A through L into the record shortly as well. So that's what we have for our documentation. As for the order of the hearing, Mr. Mather, will start with your opening and then move to Mrs. Kudik's opening. And then what witness do you plan on calling first?
We will call first Bob Sweeney, and he's kind of a volunteer here, so that
Okay.
we can cut him loose. And then John Kaufman will be second,
Okay,
and then last is Jamie Seaman. And we had we have 3 hours, but there will be different lengths of testimony for those 3 witnesses. So we will complete it in 3 hours, but each one will not be 1 hour as it kind of appears in the schedule. So
yeah, I assumed we would have a little bit of leeway based on what's said and questions and that kind of thing. We will have to swear them in before their testimony, and then once the testimony is complete, we'll have questions from the Franchise Tax Board, and then possibly from the panel if there's any questions. And then depending on our timing, we will have a longer 30-minute break for lunch. I'm not sure how much we'll get through, but that is the plan for now. And then we'll move to our presentation, closing arguments. And then if we need breaks between, just let me know, depending on how the participants are doing. I know it's going to be a longer one today, so just communicate with me and we will make it work.
my guess on the schedule is that we can do Sweeney and Kaufman before the lunch break, and then Seaman after.
Okay, we will attempt that. So do I have any final questions before we go on the record today? Mr. Mather?
No.
Okay, Mrs. Kudik? Okay, is my panel ready? All right, Mrs. Alonso? All right, we're gonna go on the record. We are now on the record the appeal of Peak Travel Group and R&L Peak, OTA case numbers 2206-10675 and 2206-10676. Today is November 14th, 2024, and it is 11:02 a.m. This hearing is being held virtually via Zoom with the consent of the parties. I am Judge Sarah Hosey, and with me today are Judge Amanda Vassie and Judge Eddie Lamb. Can I please have the parties state their names for the record, starting with appellants?
Steve Mather appearing for appellant Peak Travel Group.
And for the Franchise Tax Board?
Carolyn Kudak for the Franchise Tax Board.
Bradley Craigle for the Franchise Tax Board.
Okay, thank you. The issues to be decided in this appeal are whether appellants have shown the respondent Franchise Tax Board erred in assessing additional tax based on the built-in gains from the sale of Peak Travel Group, and whether appellants have shown whether FTB has failed to adjust the gain from the installment sale of Peak Travel Group's assets. Does that sound accurate, Mr. Mather?
Yes, and I would like to note, I think Mr. Manns was muted when he was trying to enter his appearance.
Yeah, guys, David Mann is also appearing for Peak Travel Group.
Thank you, Mr. Mann. I appreciate it. Mrs. Kudik, do those issues sound appropriate?
So there, whether appellants have established that respondent erred in assessing additional tax based on built-in gain, and then whether appellants have established that respondent failed to properly tax the gain.
Yes.
Yeah, that sounds about right.
Okay, great. Thank you. All right, as to our exhibits today, for appellant, we have pre-marked exhibits 1 through 15. Is that accurate, Mr. Mather?
Yes.
And any objections from the Franchise Tax Board, Mrs. Kudik?
No.
Okay. And then for the Franchise Tax Board, we have pre-marked exhibits A through L. Is that right, Mrs. Kudik?
Yes, A through L. Thank you.
L. Okay. And then were there any objections from the appellants, Mr. Mather?
No.
All right, having no objections, exhibits 1 through 15 and A through L are now admitted as evidence into the record. Moving to our witness testimony today, Mr. Mather, can I have you call your first witness?
Are we having opening statements first?
Oh yeah, we are having opening statements. Thank you. I was just ready to go. I'm so excited. Okay, Mr. Mather, are you ready for your opening statement?
Yes, I am.
All right, please proceed.
The overriding question I think we have today is what really are we doing here? There are two issues in the case, and I'll address them separately, with the first one being the installment gain issue. On that issue, the parties agree that the value of the contingent payment to be received in 2015 or 2016 after the year of the sale is actually taxable in 2014. So the parties agree on the law, essentially. The parties also agree, apparently, based on the statements made at the pre-hearing conference, that the appeal of a MAR case controls, and that the actual contingent payment is a reasonable and acceptable proof of the value of the contingent payment that's includable in 2014. The parties also agree that the contingent payment that was actually made in our case was $3,537,500, which was set forth in an agreement that appears in Exhibit 14 and was paid as showed in a wire transfer in Exhibit 15. So as best I can tell, every single issue in this case is agreed between the parties, and I'm not sure why we're still contesting this. Secondly, on the built-in gain issue, The parties also agree on the law on this issue, that there is an amount that is taxable in 2018 that has built-in gain based on Peak's value on November 1, 2009. The FTB based their determination that the value was $9 million on November 1, 2009, based entirely on a third-party appraisal by a company called Arxis. From what we can tell, both Arxis and this so-called appraiser are still active, but they are not appearing as witnesses in the hearing today. So they are not going to be here to try to defend that valuation. Our position with respect to that is that FTB has essentially abandoned the determination, since they're not offering anything other than a grossly hearsay statement in the form of the appraisal report, without having a witness available to determine if that appraisal is worth anything at all. And we obviously think that is worth nothing at all. So since the FTB has abandoned their determination and this appraisal, which was the sole basis of their determination, there cannot possibly be any presumption of correctness associated with that determination. If they wanted to defend, if FTB wanted to defend that determination, they needed to have somebody here to do that. So since the determination was based entirely on this appraisal, and since the appraiser is not here to even help us understand what the appraisal was about, there cannot be a presumption of correctness, and the burden of proof in this case really doesn't matter at all. And finally, even though the FTB is not presenting a case here today, we are presenting a case. We have 3 witnesses that are all testifying in more or less in unison that the $710,000 valuation in the Marshall and Stevens appraisal report is based on industry standard methods, consistently applied, and provide consistent conclusions that support that $710,000 valuation. So we're not sure, since FTB is offering nothing today, we're not sure what's left on this issue either. That concludes our opening remarks.
Thank you, Mr. Mather. Is the Franchise Tax Board ready for their opening? Ms. Kudik? Please begin when ready. Thank you. Oh, I think you're muted.
Yes, I just unmuted.
Okay.
First, my name is Ms. Kudak, so thank you. And I want to begin by saying, I assure you, I am presenting a case here today. And I'd like to begin by saying that 2 transactions are relevant to this appeal. First, on November 1st, 2009, Peak Travel Group, which I'm going to call PTG, converted from a C corporation to an S corporation. And on November 1st, 2014, Direct Travel bought PTG for $25.3 million. The sale closed in 2014, but the sales agreement specified that one payment was to be made in 2016 of up to $8 million, contingent on gross income. There are 2 issues in this appeal, as we went through: whether appellants have established that respondent erred in assessing additional taxes based on built-in gain calculated from a fair market value of $9 million attributable to PTG as of November 1st, 2009, the date of its S-Corp election, and whether appellants have established that respondent failed to properly tax the gain from the distribution of PTG's contingent payment obligation per California Revenue and Taxation Code Section 24672 and the appeal of Lamar. Respondent does not concede that we have lost the burden of proof. This is appellant's burden of proof to prove these 2 issues. At issue is the correct amount of gain to be taxed in 2014. The gain is calculated by subtracting appellant's basis from PTG's fair market value on November 1st, 2009, used to calculate built-in gain, and the fair market value of the contingent payment obligation as of November 1st, 2014, the date PTG's assets were distributed to its shareholders. This is not the same as the amount that was received in 2016. Appellants provided a report from Jocelyn Tepper and Associates, which I'm going to call Jocelyn, which estimated PTG's selling price at $1.95 million in an asset sale and $745,000 in a stock sale. Appellants provided a second report from Marshall and Stevens, which I'm going to call Marshall, which gave PTG a fair market value of $710,000 as of November 1st, 2009. Respondent hired a valuation expert, Arxis, which assessed PTG's fair market value at $9 million as of November 1st, 2009. Respondent found the $9 million valuation to be more reliable and assessed proposed taxes based on that valuation. Respondent didn't rely on the reports produced by appellants for the reasons stated in the Arxis report, pages 4 and 5. First, respondent found the Jocelyn's $745,000 estimated selling price to be unreliable because Jocelyn reported that 99.9% of travel company sales are asset sales. So 99.9% of the time, PTG would sell for $1.95 million. Further, Arxis noted that no valuation date was provided. The Jocelyn report did not say that it was a conclusion of value based on the fair market standard, and Jocelyn's expertise is in the travel industry is not a valuation firm. Respondent found that Marshall's valuation to be unreliable because Arxis determined that the financial data the valuation used was artificially low. Marshall's valuation used an income and marketing approach, applying a multiple to net income. However, PTG's net income from 2005 to 2009 never exceeded $49,000. Even though revenue grew from $61 million in 2005 to $122 million in 2008 and $95 million in 2009. During that time, EBITDA stayed constant at 3% of revenues. Arxis noted that the valuation did not normalize net income to adjust for non-operating income and expenses, non-recurring income and expenses, related party transactions, and officer compensation. As a result, Arxis found the valuation was artificially low. Respondent found the Arxis valuation to be more credible because Arxis used a market approach, which encompassed the sale of multiple travel-related agencies and also considered PTG's 2007 asset purchase of Journeys by Ambassador, which I'm going to call Ambassador. The valuation incorporated business tangible assets and goodwill and was in line with the $25.3 million that Direct Travel paid for PTG in 2014. Further, Section 7.4I of the sales agreement obligated Direct Travel to pay any tax liability associated with the built-in gain or the Section 338H10 election. The Marshall valuation, which is more than $7 million less than the Arxis valuation, was prepared for John Kaufman, who was the Chief Financial Officer of Direct Travel and who authorized the report. Appellants provide no fair market value for the contingent payment obligation at the time of its distribution in 2014 and ask to be taxed on the $3.5 million received in 2016. Appellants have the burden to show what the fair market value of the contingent payment obligation was on November 1st, 2014. Absent any proof, respondent maintains that the fair market value is the $8 million maximum sale price stated on the sales agreement. The amount received in 2016 is not the same as the fair market value at the time of distribution and can't be substituted for it. Today, I will discuss the facts of this appeal, the law, and why the ARCSIS valuation is the better estimate of PTG's fair market value on November 1st, 2009, and why the $8 million stated on the sales agreement is the fair market value of the contingent payment obligation when appellants have not met their burden to prove otherwise. Thank you.
Thank you. And I apologize for my mistake. Please correct me if I mispronounce a name or a title, honorific, or pronoun. I really appreciate it. Okay, that concludes our opening statements. Mr. Mather, are you prepared for your first witness?
Yes, we call Bob Sweeney as the first witness.
Thank you. Mr. Sweeney, are you prepared to swear in before your testimony? Can you hear us? Here we go. Can you please unmute your microphone, Mr. Sweeney?
There we go.
There we go. Thank you.
Huh.
Okay, can I please have you raise your right hand? Thank you. Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. Mather, you may please begin.
Mr. Sweeney, could you state your full name and your business address?
Sure. My name is Bob Sweeney, and business address is 3141 Simpson Park Road in Gainesville, Georgia.
Welcome. What is your educational background?
I'm a 1976 graduate of Long Island Lutheran, and I went to 4 years of college and was a few credits short of graduating.
And can you briefly describe your employment history?
Sure. I worked 9 years as a retail stockbroker for Lehman Brothers and Oppenheimer and Company. And then in 1991, I started my present company, Innovative Travel Acquisitions, and we are consultants. We advise sellers of travel companies. We are not real estate brokers. We don't advise them on anything to do with real estate as far as leases or purchases of real property. We simply consult with sellers that are looking to exit the travel industry.
So have you been in this consulting business since, I believe you said 1991?
Yes, sir.
And you continue to be until today?
Yes.
So about how many travel business sales are there in a typical year?
About 7% of the overall population turnover in a typical year. So
And what's the population?
for retail travel agencies, probably 10,000 would be the roundest number. So 700 a year.
Okay. And how many transactions have you participated in?
Well, we've sold 680 travel companies now over the last 35 years.
And is there any particular size of company that you represent?
No, we're really not bound by size. I'd say mostly small to mid-sized companies is what we wind up doing. Occasionally we'll get something large, but for the most part, mid-sized companies.
And which party do you typically represent in the transaction?
The seller,
Is that always the seller?
99% of the time.
So what's your process for deciding when you're going to represent a seller in a proposed transaction?
Sure, we send them mutual non-disclosure agreements so that we can exchange information freely, and we request them to send us last 3 years income statements, and we have a little travel agency analysis form we'd ask them to fill out. We ask them to enclose a check for $500 along with that information, and for that, they're going to get our opinion of value. And then if we are on the same page as far as what our synopsis is on what the opinion of value represents and the amount is good, then we move forward. If they say, oh, I'd never sell for that, then they've got themselves a professional report and that's it, and we're finished. We don't take them on.
So what, you say a professional report, what kind of things do you look at to determine the value for this purpose?
Mostly comparables, but the driving force is always the earnings, the EBITDA number. That's historically always been the number that's used on any business that has profits. There are break-even agencies where that formula can't be applied, obviously.
So, and how, what do you use, how do you use the EBITDA to determine a value?
Sure. I think the range is anywhere from 2.5 to about 6, maybe 6.5 times earnings on the transactions that we get involved with. And that multiple expands as the level of profits goes higher. So somebody making $1 million a year in EBITDA is going to be at the high end of that range, 5.5 times earnings in normal market conditions. And someone who's making $150,000 a year, they're going to maybe get 2.5 times earnings. They're going to, maybe you get up to 3 times earnings if you get to where you're making $400,000 a year, something like that. And then the multiple just expands upward that way.
So when so do you propose a value range to the client? Is that how it happens?
Yes, absolutely.
And that value range is based on the EBITDA multiple.
That's the biggest driving force. There are a few other factors but they're not driving it. I'd say 90% of it goes into that.
And what about balance sheet items? Do those factor in your valuation?
Sure. I mean, if there's a lot of debt in the corporation, then that puts up some red flags. And a debt-free business is more attractive to the buyer than a business that's got high debt.
So in your process, do you figure out what the EBITDA multiple should be and then adjust for balance sheet, or does the balance sheet impact what the EBITDA multiple is?
No, the balance sheet really doesn't become involved on the cash flow of the business. I think what the buyers are trying to figure out is what are the non-recurring expenses, what are going to disappear, and items like that.
Okay, so the EBITDA multiple is independent or like a first step, and then the balance sheet might adjust the overall price that you're seeking?
Sure, or the terms maybe.
Are balance sheet items typically the major factor in travel agencies?
I haven't seen them be, no.
Why is that?
There's no hard assets, and I think that the buyers are looking at the cash flow of the business. Most of them are asset sales. But I would say there's more than 1% stock sales. I'd say there's probably 15% of the transactions are stock sales.
Now, does the revenue of the business impact your valuation very much?
No.
Why is that?
Because some people, are good with expenses and other people aren't, and it's got to be a good margin that's built into the business. So, there can be a company doing 150 million in total sales and they're break-even operation. And then there's somebody who's doing 3 million in sales and they're making really good money. So it's not really relevant.
And so when you're referring to sales, what number are you referring to typically?
The total sales volume of the operation. And I think what many people from outside the industry, when they go to evaluate a travel company, they don't realize that it sounds like it's a really big company if they're doing $150 million a year in sales, but they might keep 15 million of that if it's a good mix of business. Corporate agencies might keep 7 or 8% of that. And I think the numbers get thrown around haphazardly, and what's revenue and what's sales and what's volume. And the key number is the earnings. That's the bottom line number, is the one that's what the buyers want to look at.
And why do the buyers care about the earnings so much?
They can see into the future if there's a historical trend of what it is they're going to be picking up on the cash flow side of the business. And there's usually some synergy, so that's why they do the transactions.
And are a lot of the purchases, in your experience, are they debt financed?
Yeah, there's definitely some debt financing, yeah, and there's some owner financing, and also.
Does the bank care about what the earnings are, or do they care about the revenue? What does the bank care about in a transaction?
Earnings, that's what drives it. How long is it going to take to pay it back, and will they be able to service the loan? That's what the bank looks at. They don't care about the size on the top. They care about, how much is left at the bottom. So that's been my experience. And, these travel companies, they're tough to get loans on because there's no hard assets. It's not like selling a trucking business or a manufacturing company. You can't go kick the tires and say, this is worth it. It's all goodwill. It's the relationship between the agents and the clients. That's what's for sale. And you can't put a fork into that. And, it's not the easiest thing in the world to finance.
Now, so you, going back to your process, you've given an estimate or a range of values to the client, and they've signed up. How do you find a buyer? What do you do to find a buyer for this client?
When I first started out, that's what I did for a couple of years. I went out and I met the key people in the major financial markets that were big participants in the consolidation game, and update that. But that was what I did for 2 years. Just went out and met everybody I could on the buy side.
And so what factors go into your finding the right buyer for your seller?
There's things like global distribution systems. They have to match up, and mix of business has to match up, and the culture of the company. And it's we're somewhat operate like a dating service. If somebody wants a corporate agency in Chicago, then we go and find them a corporate agency in Chicago.
So, I mean, is it your experience that the buyer cares about the EBITDA also?
Oh God, I mean, yeah, that's it. I mean, that's what they're looking at. That's the number.
So, is it fair to say that you're trying to give a parameter to the seller because you know what the buyer's looking at?
Correct, yes. I mean, if I think we could get the person 4 times earnings because they're making, whatever it is, $800,000 a year, I'm going to tell them that's what I think we get it. We may market it 5 or 10% higher than that, ask a little so that we can have wiggle in our knees and be negotiable. But absolutely, yeah, I tell them if we can wind up at this number, you should be happy with that. And if they agree that they would smile at that level, then we take them on.
So when you're doing your initial estimate for the client, is it a pretty narrow range that you expect the transaction to close in?
Yeah, it's fairly tight, sure.
So when you say 2.5 times EBITDA to 6 times EBITDA, that's not a single client. That's just the range of all the transactions that you've seen.
Well, I mean, I've seen it got frothy back there a little bit in the 2015 and 16. People were paying 6.5 times, but that was brief, and it went away real quickly. Typically, I think 2.5, and in today's world, 5.5 might be more the high end of the range.
But for a particular client, you're saying, well, maybe we can get 4, but we might be able to get 4.2. Is that kind of that type of range? Not
Yeah.
maybe we can get 2 or maybe we can get 6.
Oh, no. Something tight.
Yeah. Now, if you could turn to Exhibit 12, which is your letter dated May 11, 2023. Have you got it?
Okay. Okay, yep.
All right, I'd like to go through a few comments on in this letter. So, and I think this is maybe repeating a little bit, but only. So you say that we only accept clients that understand they will be valued by one metric, EBITDA. So what exactly does that mean?
That means we're not gonna take on a listing of somebody who's telling me about the potential of the company and what they got planned for next year. It gets them to understand that it's gonna be a report card based upon the last 3 years' earnings, with the heaviest weighting being towards the most recent 12 months. They have to understand that going in, and then
So why do they have to understand that?
because we don't want to waste our time with someone who thinks their business is worth, 10 times what it's worth. We can't afford to do that.
And is that because the buyers are just going to be, I mean, do you know what the buyers are going to limit the price to?
Yeah, I mean, we save people time and heartache. That's what we do here for sellers.
So how do you determine what the EBITDA is for a particular seller?
Take the earnings before interest and taxes and look at the depreciation, the amortization, and there it is. It's right. It's undisputable. It is what it is.
And that's the information they provide in the initial package that you mentioned?
Yes.
And is that information usually communicated to the buyer then?
Sure. Yeah. The buyer gets to see all the information that they share with us, once they've signed a confidentiality agreement.
Now, you also say, and I think you mentioned before, the range we see is 2.5 times EBITDA to 6 times EBITDA. And again, that's the range in all the transactions in your experience, right?
Correct.
So it's not the range in an individual transaction.
No.
And could you explain again what causes it to be lower or higher in that range?
They may have just signed a long-term GDS contract, taken a bunch of cash. That would lower it. That's one thing that pops to mind. They may have just signed a long-term location lease that they don't need. That would lower it. I mean, there's things like that that could lower it, but for the most part, they're not going to move the dial very much.
You said a bigger agency might be higher in the range. Why would that be?
It's just the way it is. I mean, as I said in the beginning, the multiple expands as the level of profits goes higher. So again, the guy making 150, he's going to get 2.5 times like that. The guy making 300, maybe he gets 3 times. And then it goes to 3.5 if you're making, 400, maybe you get 4 times if you get up to $500,000, 4.5 times at 750. So it's a sliding scale that expands like an accordion as that level of profits goes higher.
And is there a reason for that?
I just think more solid earnings that, it's there's more infrastructure that would come with that typically.
Now, in our case, John Kaufman submitted a declaration that EBITDA multiples were typically between 3 to 9 times.
Mm-hmm.
How often have you seen anything close to 9 times?
I don't swim in those ponds at the very top. So 6.5 is the highest that I've seen personally.
And one of the transactions that was mentioned before was an ambassador transaction where there was an EBITDA multiple of 2.7. That was a sale in 2007 for a business that was exclusively in the leisure travel market. Does that seem like a reasonable multiple for that type of business in 2007?
I wasn't involved in that transaction, so
Sure.
it sounds, doesn't sound crazy.
It would be at the lower end of the range. Does that seem appropriate for a leisure travel agency?
When was it? What year?
2007?
I don't know. We all know what happened after that, 2008. I mean, leisure business goes away, really quickly. They don't have to travel. So, if somebody had their crystal ball out and knew that we had a major banking crisis coming behind it, that multiple probably was a little more than I'd pay myself.
And is leisure travel versus corporate travel, is there a difference on the multiple typically if that's the primary business of the agency?
No, the leisure agencies they don't get as big as the corporate agencies do.
Now, another transaction was the sale of Peak in 2014, and that had a 5.9 times EBITDA price or entity valuation based on with EBITDA of over 2.5 million. Does that seem like a reasonable range in that for that time frame?
Absolutely, yeah.
So nothing out of the ordinary on that.
No.
Now, the valuation report that was submitted in the case from Marshall and Stevens used a 5 times EBITDA for the same Peak travel agency in 2009 when it had an EBITDA of $287,000. But how does that strike you any particular way?
Yeah, not much reality baked in there. No.
What do you, is it low? Is it high?
You don't pay 5 times earnings for something that makes less than 300. I've not seen that.
So that's an EBITDA, the 5.0 would be on the high side of what you would expect.
Very high. Yeah.
And was there anything about 2009 that would cause the EBITDA to change?
I forget how long it took us to get out of that mess, but the travel business goes up and down real quick. I know that's for sure. So, I don't think there was any dramatic event that should change that. But, paying 5.9 times earnings for a business making that kind of money, that's right in line. That's about what you would expect.
That's 5.9 for when it grew to 2.5 million, right?
Yes.
Okay. Now, you may have heard that there is an appraisal report authored by Arxis that is relied upon by the Franchise Tax Board in this case. And they have, on this same 287,000 of EBITDA in 2009, they determined an enterprise value of $11.4 million, which is an EBITDA multiple of almost 40. What do you think of that?
Greenland. I don't know what they were looking at, but that's probably the most absurd thing I've ever heard.
So is that consistent with any transaction that you've ever seen in your career?
Never, not even close.
So if the seller had come to you and said, I want 11.4 million for my company with EBITDA of 287,000, what would you have done?
I said your EBITDA needs to be 2 million plus to get that number. So come back to me then.
So for a 287,000 EBITDA in 2009, how far off base do you think 11.4 million is the value?
Like 10 times too much. I mean,
so that'd be 10 times more than any transaction you've ever seen in your career, correct?
That level, yeah,
Yeah.
I mean, pay somebody 3 times earnings for that, it's about right. They want more, but that's what they wind up getting.
Right. So three, a multiple of 3 would be closer than a multiple of 40.
Yeah. So maybe they're 13 times off,
All right. I have no further questions.
Thank you. Thank you, Mr. Sweeney. I'm going to see if the Franchise Tax Board has any questions for you. Ms. Kuda, do you have any questions for Mr. Sweeney?
Can I ask for a quick break so that I can confer with my co-counsel?
How, just like a few minutes?
Yeah.
Okay, let's get back at 11:47.
Okay, thank you.
You can turn off your cameras and mute your microphones, please. We are off the record. Okay, we are off the record still. It's 11:47. Let's see if I have my panel with me. Hello. And Ms. Alonso, you ready to begin? Okay. We are back on the record. Mr. Sweeney has just finished his testimony. Does the Franchise Tax Board have any questions for Mr. Sweeney?
Yes, we do.
Please begin.
Okay. The first question is, have you ever had any transactions with Direct Travel?
Yes.
Okay. How many transactions?
Oh, I don't know, probably 15 maybe.
Okay. And have you done any prior business with John Kaufman?
Yes,
Okay. And again, a rough estimate of the amount of deals or,
same, about 15. John's been the CFO.
okay. Um, and have you read the ARCSIS report?
I glanced at it until I saw the 39 times EBITDA number, and then I kind of lost interest.
I see. And did you read the Marshall report?
I glanced at it, yes. I'm doing this because I saw something said 39 times earnings. I had to say that someone needs to be called out on that.
Mm-hmm.
That's why I'm here today, just to point out that absurdity.
I see. And this is a yes or no question. In your experience, can EBITDA be compressed?
Yes.
Okay. Okay, those are the only questions that I have. Thank you.
Okay, thank you. I'm going to check with my panel really quick, Mr. Sweeney, to see if there's any questions. Starting with Judge Basig. Do you have any questions?
Not have any questions for Mr. Sweeney. Thank you.
And Judge Lim, are there any questions for Mr. Sweeney?
I'm going to hold my question. Thank you.
Oh, I think we're going to allow him to leave once his testimony is complete. But if you
yeah.
have any questions for Mr. Mather, then we can hold those till the end if you'd like.
Yeah. No, it's okay. I don't have any questions for Mr. Sweeney.
Okay. Thank you.
Thank you.
I don't have any other questions either. So, Mr. Sweeney, if you'd like to leave, you are welcome to.
Thank you. Thank you. Appreciate
Thank
it.
you for your time and effort today. We really appreciate it.
Sure, thank you. Appreciate it.
Okay, Mr. Mather, would you like to call your next witness?
Yes, we call John Kaufman.
Okay, Mr. Kaufman, can you hear me? Can you hear us? I think you're muted.
Yes, ma'am.
Hello, welcome.
Thank you.
We're going to swear you in before your testimony. Can you please raise your right hand? Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
Yes, ma'am.
Thank you. Mr. Mather, you may begin.
Mr. Kaufman, could you state your full name and business address?
Yeah, it's John Kaufman, 7430 East Cayley Road, Suite 320E, Centennial, Colorado, 80111.
I note you have a handsome collection of model planes up behind you there. So.
I have been in the travel industry for quite a while.
So what's your educational background?
I got a Bachelor of Science in Business Administration from University of Tennessee.
And can you briefly describe your employment history?
After university, I was with Price Waterhouse for approximately 13 years. I was in the audit division and part of their mergers and acquisition consulting division. After I left Price Waterhouse, I joined a company called Navigant, which was another corporate travel management company. We grew through several acquisitions, and eventually it was sold to another travel company called Carlson Wagonlit Travel. And then I stayed with them as their global mergers and acquisition person. And then from there, I left and joined Direct Travel as the CFO.
And what does direct travel do?
We do corporate travel management, but we also have a high-end leisure division as well as a meeting and event division. But the bulk of our business is corporate travel management.
And do you have any certifications?
I am a licensed CPA, certified public accountant, which requires me to take continuing education on an annual basis.
And how often is your continuing education focused on valuation or financial analysis?
So, as mentioned, we have to take 40 hours every year, and so I've been doing that for the last 40 years. Because I spent so much time doing mergers and acquisition, throughout my career, I've done over 150 that I orchestrated. And then, as I mentioned, when I was with Price Waterhouse, I was involved in quite a few on behalf of their clients. And so I try to take as many of those classes in the mergers and acquisition, but I don't have a track record all the way back for those past 40 years, but it's quite a few.
So over 100 hours of classes?
Oh, definitely over 100 in mergers, yes.
So why is the financial analysis or valuation, why is that important in merger and acquisition?
Well, so I think something that everybody should keep in mind, fair market value is what a willing seller and a willing buyer are willing to pay for a business. And so you have to come up with that valuation so that you can find a willing buyer and a willing seller, to make sure you can properly execute on a transaction.
So it was that when you were at in accounting, was that you were involved in those types of determinations as well?
Yeah, so usually on that aspect, when I was with Price Waterhouse, we had clients who would do most of the negotiations. We would then perform the due diligence and work around the financial accuracy to tell them whether that valuation they had proposed or agreed upon was still a valid multiple of EBITDA for them to make the transaction.
So why was EBITDA so important?
Well, EBITDA in most aspects of a business represents free cash flow. And anytime you're doing an acquisition, you have to have a rate of return. It's no different than if you're investing in, stocks or anything else. You want a rate of return. And so everybody, to justify to their shareholders and to their board, needs to have a reasonable rate of return, which is based upon free cash flow to the valuation.
Now, so about how many years have you worked in the travel industry then?
Approximately 27.
And did you apply those EBITDA-based methods in the travel industry as well?
Definitely. We in the first company, Navigant, we grew through about 80 or 90 acquisitions. Then when CWT acquired them, as I mentioned, I was doing global mergers and acquisitions. As Direct Travel, we've done a little over 50 of those transactions, and every single one was based upon that EBITDA and free cash flow.
So what was your role in those transactions generally?
I've been pretty much a team of one to where I negotiated the purchase price And I had a couple of employees working with me when we do the due diligence. I'd supervise it. I'd often have to hire, whether it's, depending upon the size, get a quality of earnings from one of the big six accounting firms. And I'd manage that process as well as work with the legal advisors on the actual agreement to purchase the stock purchase agreement. And then I would make the presentation to the board and to any shareholders to justify the acquisition.
So you said a quality of earnings. What's that?
With any deal over a certain size, you want to make sure that the EBITDA that you're basing that valuation on is accurate. And so we often engage, and I'm doing one right now for a very large acquisition, somewhere in the range of 340 million. You engage a third-party accounting firm to go in and verify that quality of earnings that they have represented, so that the board and the shareholders feel comfortable with the multiple against that EBITDA.
So how often do you have that that quality of earnings report in these transactions? Is it most of the time, or?
No, because most of my acquisitions have been in the small to medium size. Again, it's typically when it's over a certain dollar value. We had our loan covenants with a couple of times where we had our lenders that required anything over a $20 million purchase price to have that quality of earnings. And then we've had our board put some thresholds over my career on certain sizes. But it's only the really large ones that you do that for.
And you mentioned the board. Describe the process for the transaction getting approved.
But as you can suspect, the board has various liabilities in managing a company. And so we have to go in and present the presentation on the return on investment, on the assets that or the stock we're buying. We actually, in our deals, in the 150 that I've done, every single one was a stock deal, not an asset deal. And so we have to go in and verify, the reasons we're buying it, the areas that, why we want to expand into that area or that part of the country or into that jurisdiction, as well as the risk associated with any acquisition. What's the potential downside as well as potential upside with cost avoidance and/or cost savings.
So did the board care what the multiple of EBITDA was in a particular transaction?
Very much so, because again, they have to have that return on investment. They have to justify that they're going to recoup their money that they're outlaying within a reasonable time frame. And as well as we have every company I've worked for had some debt associated with it. And every debt deal has a covenant that you must have a multiple of your own EBITDA to your debt. It's called a leverage ratio. And so if you pay too much for a business and cannot pay down the debt associated with it quick enough, then you will be out of compliance and the banks can take over your company. So it's a very important aspect for every board member.
Now, going back to the transactions themselves, what did EBITDA factor into the actual negotiation discussions ever?
Yeah, I'd always start off my discussions. If I was buying your agency, Steve, I would sit there and say, I'm willing to pay you 4 times, 5 times your EBITDA. And they're always presenting to us what that EBITDA is. And then we go in and test it in due diligence. they may come back and say, I need something higher. And we might meet in the middle during the negotiation, as with any negotiation. But typically, the ranges are pretty close when you're having that discussion. It's not like I say I'm going to pay you 4 times, and they say, well, I want 15 times. We're never going to get to a reasonable amount because it would never A, be approved by the board, and B, meet my loan covenants that I have outstanding.
So in most of your transactions, you've been on the buying side?
I was on the buying side for all of them since I left Price Waterhouse. When I was with Price Waterhouse, I was on both sides.
And you heard Bob Sweeney testify before, is that right?
I did. Yes, I listened to it.
Yeah. And so he said that I believe he said that he discussed the EBITDA multiple with his potential clients as well. And so, and that they had to provide the financial information to him. So would that be how you would typically get the financial statements and the EBITDA calculations from the buyer's agent, if you will, or seller's representative?
Yeah. So, yeah. I mean, there's a handful of brokers out there. Bob is the largest, or has been in the business the longest. But I deal with quite a few other individuals. Where they're helpful, the brokers, the representatives, is that sometimes the owners may not be as sophisticated in performing a transaction. So they're good at helping educate those owners in those transactions. In other situations, I deal directly with the owner. They're pretty sophisticated. They've come from a financial background, and so they're able to understand EBITDA and multiples without any kind of representative.
So when there isn't a broker involved like Bob, the discussion still focuses on EBITDA multiples?
It does. It does, but I mean, it's a pretty well-known in this industry because, again, Bob mentioned it, you're not buying hard assets. All you're buying are a cash flow. It's a cash business and a cash flow. And so everybody who buys businesses in any industry that's a cash flow business uses EBITDA for that. And so these people understand it. There's trade publications out there in this industry that have talked about EBITDA and multiples. It's just a widely known factor of how this industry has bought and sold businesses and valued businesses, because again, the fair market value is what a willing buyer and seller are willing to exchange.
And how does revenue factor in to these negotiations or discussions?
It really doesn't, because again, there are travel companies that have a lot of international travel, and so they have higher commissions, higher fees. There are companies that focus more on leisure. The meeting and event companies have a lower fee, lower thing. It all then translates based upon their expenses. It comes down into EBITDA. So if you have two companies that are performing similarly, it will flow down into the EBITDA. So your best measurement is always EBITDA. And Bob mentioned they could have high rent. They could have, low supplier deals. They could have, if it's an agency in a small town, they're not going to have very good supplier deals because it's not a competitive market. If it's an agency in New York, they're going to have competitive. And so everything just happens to flow to EBITDA.
And what about balance sheet items, assets or liabilities? How do you take those into account if at all?
Yeah, the only time you really take, and I can tell you in all my deals, assets are minimal because again, everything's on credit card, so there aren't huge receivables. 60 to 70% of your expenses are your salaries for employees, your agents and your managers and stuff like that. So there's not payables associated with stuff. The other biggest expense is rent. So again, that's not a payable. You pay it at the start of every month. So there's very little in assets, very little in liabilities. And the only liability that factors in is if they have debt. And when you look at, I believe both the Marshall and the Joslyn, they mentioned that back in that 2008 valuation, there was debt. Now, I want to correct the other attorney because she mentioned the asset purchase that Joslyn talked about is 1.5 million. The reason there's a difference between an asset purchase of 1.5 and a stock purchase of 745 is because in the stock purchase, the buyer would inherit that debt. In an asset purchase, the seller has to pay off that debt. So those two valuations are identical. The owner is only going to get 745 because he has to pay off the debt of 800,000 or so. So it's not, that's the only time that you have to factor in and a liability is debt because you have to pay that off and that adjusts what the owner will eventually take home. Whether they pay it off or you pay it off as part of the purchase price, it reduces the price overall.
So as long as we're on this topic, why don't we jump forward to the direct purchase of Peak in 2014? Now, Peak had some debt. Is that what you recall?
I don't recall debt that he had. I know that the eventual price we paid was the 15 million. And that was it was slightly under 6 times his EBITDA.
But the seller didn't get a check for 15 million, did he? Or do you recall?
No, if he had debt on the books, he would not have taken home 15 million. You're exactly right, sir.
So, and how would the debt have been handled typically by you in that transaction?
Well, because we have we already had a debt agreement. We were prohibited from inheriting debt in our stock deals. And so we would pay off that debt and reduce the amount that the owner took home. And so if let's hypothetically say there was 2 million of debt, we would have written a check to Robert Peak for 13 million and written a check to his bank for the 2 million to pay off the debt. We have to get it off our books because of the debt agreement that we have in our possession.
So could you turn to Exhibit 11, which is your declaration that you submitted in this case?
Yes, sir.
Now, in in paragraph 11.
Yes, sir.
You indicate that Peak's EBITDA on November 1, 2009 was 287,000. How did you determine that amount?
It was through a review of their financial statements. Obviously, I was not, we did not own them at that time. So I took their income statement from both their tax returns as well as just their normal financial statements that the company produces.
And but in the context of the ultimate purchase, if you recall, of Peak by direct, would you have received similar information from Peak?
Yeah. Basically identical information. It was still their internal financial statements. We reviewed tax returns as well as some other documents, but the number one item is their internal financial statements. Yes, sir.
Do you recall if Peak had audited financial statements?
I do not, they did not have audited.
It was that typical for this industry?
Yeah, this industry, very few have audited unless very few that I've ever acquired had audited.
And so you typically accepted or attempted through due diligence to verify the information that the seller provided. Is that right?
Yes, sir.
Okay, now if you could turn to look at page 9 or paragraph 9, I'm sorry, of the same Exhibit 11. There's reference to the Journeys by Ambassador transaction. And you indicate that there was a multiple of 2.7 for that transaction, which again was not direct. Direct was not involved in that transaction, correct?
That is correct, sir.
So that was a Peak transaction before direct, long before direct purchased Peak.
Yes.
And you didn't work for Peak before you worked for direct, correct?
No,
Okay.
I did not.
So 2.7, what would be the factors that would cause 2.7 to make sense for that transaction?
Yeah, so there's three things. If I was doing the transaction, why I would come up with a lower number such as 2.7. A, it's a very small agency. Two, it's up in the Northwest. It's not in a major city, so it's not a bunch of competitive markets. And again, you get a lot better supplier deals and able to leverage the suppliers in competitive markets. And then the biggest factor, Journeys by Ambassador was a leisure agency. In leisure business, the agent controls the customer. And think of yourself, every one of you, if you've ever used an agent to book your leisure travel, if that leisure person, or think of your barber or hairstylist, if they move to another location, you follow them to the other location. So if I purchase that agency, there's a chance, there's a risk that they're going to leave after a year, 2 years, or whatever. And therefore, again, you got to get your return on investment, weigh the risk, and value how long you're going to get that cash flow. And that's where you come in with the lower multiple, because there's a higher risk that you will not retain that business long term.
So I guess, I mean, is it fair to say that when we're talking about the multiple, it's not just a number, it's about how quickly the buyer's going to get their money back?
Oh, 100% how quickly the buyer's going to get their money back, because that's how you calculate return on investment. And that's how you make happy shareholders and everything else. You have to be able to generate that, because for that period of time, you're paying off that acquisition price, and then after that, that's free cash to your shareholders. So the quicker you can get your money back and pay off that purchase, the quicker your shareholders start reaping the benefit of that acquisition.
So the smaller the multiple, the quicker you get your money back.
Definitely, yes.
And you mentioned the size, that it was small. What does that factor into how the multiplier or the multiple usually ends up?
Definitely, because they're less sophisticated, so they have less automation, less technology, and smaller ones are usually set in their ways. And so as a larger company, you come in and start changing things around, you can alienate them. And so again, you're going to run that. There's a higher risk that you won't be able to recoup your money. So you have to go to a lower multiple in those situations. The larger the agency, the more sophisticated, the more used to them doing things the way you do things. And therefore you can pay a little bit more for those companies.
Now, we saw that or talked earlier about how the and I think you mentioned that your multiple on the ultimate peak purchase was closer to 6. And the Marshall and Stevens report in 2009 uses 5. So I think 5 to 5.9. Is there a reason that there would be that difference?
Yeah. In 2009, it was a smaller agency. And therefore, I would have used, if I was buying it, I would have used a lower multiple. It's still a strategic, it's in the San Jose area. And so, we're the Silicon Valley. So, you can't go too low because it's a strategic area and near San Francisco, where it's a very competitive airport and stuff like that. So it might be a tad, 5 might be a tad higher than I would have started with, but I can see where 5 is a very reasonable for, and the differential between the 5.9 and the 5 results in why it would go down to that 5 just because of the size.
And in fact, the EBITDA in 2009, I think was, or the EBITDA in 2014 was almost 10 times what it was in 2009. Isn't that right?
Well, it is. And if you want a fun fact, Steve, so you take that 15 million we paid for peak and the EBITDA was 10 times, reduce that 15 by a factor of 10, you get to the around 1.5, which is what both Jocelyn and Jamie's valuation for the company back in 2009 came in at before deducting debt. And so we paid very similar. It's just that the EBITDA was 10 times higher.
Now, in your, again, in your declaration, Exhibit 11, you refer in paragraph 7 to a range of EBITDA of 3 to 9 times. And,
Yes,
and
sir.
you heard Bob Sweeney say that he'd basically never seen more than 6.5. How often had you seen more than 6.5?
Not very often. And again, typically those are only your bigger agencies. Obviously, the one I'm talking about for 340 million is it's at 8 times. Direct Travel and Navigant sold numerous times to private equity investors, which, as anybody would know, private equity are some of the most astute financial advisors or financial investors out there. And during those times, Direct Travel and Navigant never sold above 9 times. And I have acquired one agency at 9 times, but it's a rare circumstance, and typically it's only when you have an investment banker, such as a Goldman Sachs, such as a Jefferies, Morgan Stanley, who are representing the buyer and the seller, and the price does get driven a little bit higher because of those investment bankers and the work they put forth and the costs you're going to have to incur. But again, as many times as my company has been sold, which is probably 6 times, and as many large acquisitions as I've done, never above 9. And it's only a handful that have even exceeded that 6.5 times that Bob mentions.
So for somebody like Peak, would an agency like that, would you ever expect them to be much above 6?
No, not at that price range. We just sold, and we had 70 million EBITDA, 70 million to that 287 or to that 2.5 a Peak, and our multiple was 8 times. And it was negotiated as a multiple of EBITDA. They didn't ask about revenue. They didn't ask about anything else. It was 100% we're going to pay you 8 times your EBITDA.
So you saw Bob Sweeney's testimony, which was kind of from the seller side. Was there anything that you heard in his testimony that seemed different than what you saw from the buyer side in these types of transactions?
No, he talked to, I mean, he and again, it's somewhat of an industry knowledge. He preps his sellers for what buyers are going to be looking for. And again, you got to have a willing buyer and a willing seller at a price they're willing to exchange. And so he's prepping them for what he knows companies such as myself, CTM, Amex. I mean, there's a lot of them that are out there looking for acquisitions, but we all do it the same way. And many times I'm competing with another one of those for that acquisition, and we're both talking the same language to the seller. So his testimony sounded very reasonable because he's getting the seller comfortable with our language that we're going to be talking.
So when you're competing with another potential buyer, it doesn't cause your EBITDA to go from 4 to 8.
It can't, because again, I've got loan covenants. If I purchase something at too high of a multiple, I bust my loan covenants and the bank takes the company over. You just can't go to crazy multiples. And we know that I've lost. I've told you that I've purchased 150. I've lost 200 deals. But you have to have rigor and know what you can accept for your risk and what your board is willing to accept and what your lenders are willing to accept.
So do you think that the other kind of major players, do they have similar loan restrictions and financial issues that cause them to evaluate the transactions similarly?
Yes, very much so. Obviously at various conferences, I bump into my peers, but yeah, everybody does things the same way in this industry. Otherwise, they'd win all the deals, but right now they don't.
Right, they'd win all the deals and then go out of business, right?
That's right.
So could you turn now to Exhibit C, which is the Arxis valuation report?
Yes, sir.
Now, the value that they came up with in this report was a net of 9 million after an enterprise value of 11.4 million based on the 287 of EBITDA.
Yes, sir.
Does that seem reasonable?
Well, I think Bob used the word absurd. I'd use something even worse than that. Again, I would ask anybody who's on this call, would you be willing to pay 9 million for something that produces 287,000 in free cash flow? I don't know of an investor, a banker, a private equity that would pay that for a travel management company which has marginal year-over-year growth. It's just not something that you can never finance that, and B, you can never recoup your investment ROI in a reasonable time frame.
So what would I haven't done the math, but how many years would it take to get your money back in that? I guess if it was 300,000, then it's 30 years?
30 years, yes, sir.
So that's not reasonable.
I don't think anybody could find an acquisition in the history of acquisitions that have a 30-year return on your money. I've never heard of one in anything that I've talked about.
So the Arxis report primarily used revenue as a basis for determining the market value? Is revenue, I think you kind of alluded to before, is that a good indicator of what the value of an agency is?
As I mentioned, I've never heard of anyone in this industry that has used revenue. There are other industries like the retail that has a revenue, but this industry has never used revenue. And here's an interesting fact, Steve. The revenue they used was total air sales. That's not our revenue. The air sales gets paid to the airline. All we get, so if I sold you a $10,000 ticket, I get $25 for the transaction fee. That $25 is my revenue, not the $10,000 that you paid to United or American or Delta. And so Arxis, for some reason, used the price of the airline tickets. Now, another fun fact, our revenue is typically about 9% of what that airline price is in the end. And again, if you reduce that valuation of 9 million by a factor of 10, you come back to the same valuation. If they had used the right revenue, they would have come to our valuation that the other two valuation firms use. Because again, the revenue in theory should flow down if you're using the right revenue.
So just so I'm clear on that, so then when you're in your example of a $10,000 or $1,000 ticket, does the agency even ever receive the money?
No. It's a credit card. The customer uses their credit card, and the merchant of record is American Airlines, United Airlines, whomever. It is not the agency. They then remit to us on a separate charge our $25 transaction fee that we record as revenue.
But it seems that in at least some of the financial information that we've seen, the gross booking revenue or the air, what do you call it, air something?
Air sales, yes, sir.
Air sales, it gets reported by the agency. Why is that?
So this is going to take you back a long time, but the global, and Bob referenced it, global distribution system, and that's what our agents use to book the tickets, the hotel, the rental car, all the aspects of your travel, is going through the global distribution system, which feeds information to our accounting system. The global distribution systems were all invented by the airlines. They used to be part of the airlines. And so Travelport, which is one, used to be part of United. Sabre is one. It used to be part of American Airlines. Amadeus was one of a European airline, Air France KLM, I believe. And so they designed it to where it did feed into our accounting system because it used to be part of their systems. It feeds that air sales in, but that's not our revenue, and the money never gets transmitted to us. It only gets transmitted to the airlines.
Okay. Now you mentioned, which I think is Exhibit G, the Jocelyn report or valuation.
Yeah.
How is it that you came into possession of this? Do you know the circumstance that this was done?
I do not. When we made the acquisition, of Peak. And we had the information. Let's see here. Let me just pull it up real quick. We got the information, and we're filing the Section 338 H10 election, and we knew we had to factor in the timing of the conversion from the C Corp to the S Corp. I think Tyler Peak said here, I've got a valuation of near the time I did it because I was looking at it, but that's hearsay on what I recall. He told me how he engaged Jocelyn. Again, I was not part of Peak at that time that he did it. And so we determined we needed another valuation so that we had two of them. And that's when we engaged with Jamie from Marshall Stevens.
So the term that Jocelyn uses, did you know who Jocelyn was?
Jocelyn is an industry consultant, and he has also represented companies similar to Bob, but that's not his more full-time job is a consultant to travel management companies to help them improve their financial results.
Now, he doesn't talk about EBITDA in this letter. He talks about, what's the name? What is it?
Free cash flow.
Free cash flow. So what, is that the same thing as EBITDA, or is that something different?
For these agencies, it is. I mean, your free cash flow will negatively be impacted by your interest payments. But as when we're looking at it, we're getting rid of the debt, and therefore it turns it into EBITDA. But in normal situations, we view EBITDA and free cash flow as one and the same.
So he used a 2.5 multiplier here on the free cash flow. So that would correspond to 2.5 times EBITDA.
Yes.
Or pretty much.
More or less. Yes.
All right. Now I'd like to turn just briefly to Exhibit 14. This relates to the other issue in our case, which is the contingent payment that was due to Peak in the transaction where Direct bought it in 2014. So can you explain what Exhibit 14 is and how it relates to that contingent payment?
I failed to print that one off. I'm extremely sorry.
Okay. It's entitled Agreement and Authorization for Earnout Payment.
Oh, yeah. Okay. So, and this is, again, this was misspoken by the other attorney. When we negotiated with Peak, we always purchase an agency based upon their EBITDA, as I've stated. When Peak was selling, he told us that he wanted a higher purchase price. I said, we can't, we base it upon your EBITDA. He said, I just sold a bunch of new accounts that are going to make a lot of additional EBITDA. So I think what I'll do is I'll just wait 6 to 9 to a year, and then when I sell it, it'll be worth more. Well, we were very eager to expand into the West region, and in particular, San Francisco, San Jose area, because of the Silicon Valley and the growth of those customers there. We had a huge presence in the East, a huge presence in the Midwest, and we had a 3-person office in San Jose. So I said, I need to buy you now. And he said, I need credit for this new business. And so I said, okay, your current business is worth 15 million, just under 6 EBITDA. What I'll do is pay you a similar multiple on the growth of your EBITDA over the next year. If you grow nothing, you get your 15 million and that's it. So the value of that earnout payment at the date of the transaction was 0 because there's no guarantee of growth. He ended up growing as he anticipated because he had those new customers. He didn't know how much those new customers would travel or, you know, how profitable those new customers would be. He just knew they would get somewhere. And then we paid him at the end of the next year, we paid him that similar multiple for that earnout, which was about 3.5 million. And so that earnout related to merely the growth in the business over the year I earned it as a mechanism to permit me to buy it today instead of waiting a year and potentially somebody else coming in and buying it and I losing that acquisition, which we found to be very critical to our business strategy. So it still was a little over, just under 6 multiple. It was just paying it on the forward EBITDA.
So a couple of things about that. First off, there was a cap of $8 million, I believe. Is that what you recall?
There was. We put that on there just to say there's absolutely, you know, no matter how successful all that new business is, I can't, my lenders at this time, I can't go any higher than an 8. But it was just a hypothetical cap. We had no expectation. He had no expectation that new business would ever be able to reach that number. And again, it had to grow. It's purely what that business grew by and then me paying. It's incremental. It wasn't like I was taking part of the original purchase price and holding it back. It wasn't a holdback. It was an earn up.
And it would have had, if I guess if we're talking a similar multiple, how big would the agency have had to grow the EBITDA in a year to cause it to be 8 million? Would it have to be 50% more? Is that kind of the math on that, or?
So yeah, because it was a 15 million original price. So you're exactly right. They would have had to grow by another, the original was about 2.5. So yeah, they would have had to grow by approximately 1.4 million of EBITDA in 1 year, which just is impossible to happen.
So the 8 million isn't really any kind of indication of what the value of that earnout was at when the transaction closed.
No, and in fact, again, I say that the value of that earnout was 0 because let's and I had one other deal that had a similar arrangement that happened right before COVID. Guess what? They got 0 because the business did not grow during COVID. And so the value of it is only if those customers transact, and B, if those customers are profitable. So it has no value until those customers transact and they're profitable and contribute to my cash flow in that subsequent year. But I had one that got 0 in COVID.
So you call it an earnout, but I mean, is that term used in another context in some deals, or is this a popular? Is this the typical where it's based on an increase in the future, not just a percentage of future revenue, whether it's up or down?
So very rarely, again, it's a handful of deals that I use the true term earnout. And it's based upon the future growth of that business. And it's usually because the owner, it's a way for me to incentivize that owner to sell today as opposed to waiting a longer period and selling down the road. And again, potentially losing out on that acquisition because one of my competitors comes in and buys it without me knowing. So it's just a tool. Now, most of our deals do not have an earnout. We only pay based upon your actual EBITDA as of the date of the acquisition. That is 99% of our deals. There's just a handful that I have to that are very, very strategic to where our board and where our management wants to go, that we have to have an earnout. But again, you're only paying on that EBITDA.
So it's not really a situation where you're giving him 50% up front and then you make payments so long as the business doesn't go down. I mean, that could be called an earnout too, I suppose, right?
It could. Yeah, I think you're right. And I think what if you when you look at the transcripts, I use the word earn up when I describe where you can actually get more than the original purchase price. What you described where you get a certain percentage of the purchase price, I would agree. That's what you could also call an earn out. And that's just helping you get to that end purchase. You negotiate a price. You say, I'm going to pay you $5 million for your business. I'll pay you 2.5 today, and I'll pay you another 500 or whatever over the next period of years, as long as your business stays flat or better.
Okay, so the amount in this Exhibit 14, the exact amount is $3,537,500. And then in Exhibit 15, we have a wire transfer for that same exact amount on the next day. So was that everything that was paid under that contingent arrangement?
Yes. Yeah, we only had the one earn up, 1 year earn up for Peak. And we made the one payment once we all agreed to the amount.
So what was that process then? How did you determine what the amount was?
So we took his earnings 1 year later, his earnings, and compared it to the 2.5 million EBITDA that was when we acquired it, and then applied the multiple to it to get to what that payment would be.
Okay, so that 1 year then was when Direct owned Peak.
Yes.
Yeah. Okay. And was there anything beyond the year? There was no agreement?
No. We would never do that long term, Steve, because you have to integrate the business. And so we want them to start using our benefit plans for their employees. We want them to start using our insurance for the business. We want them to start using our phone system. And once you start doing that, you can impact the EBITDA. We want them to have better computers, better this. And so we're trying to turn the business into a more efficient, more effective machine. And therefore, you can't rely on that EBITDA. So when you have this earn up situation, you got to kind of do a hands off so that the owner doesn't question that you harmed his ability to earn on the earn up. So you got to keep it short term in nature to permit the ability for you to execute on your overall acquisition strategy.
So, I mean, you obviously interacted with Tyler Peak on a lot of the Peak Travel Group financial reporting. Did you ever find that to be inaccurate or to see that he was playing with the numbers at all?
No, No, they had good books, and the larger you get, and he's considered a large agency. Anytime you get into double-digit million acquisition, they're going to have a fairly sophisticated accounting department that is helping them out.
Okay. Maybe just one last question. If you still have the Marshall and Stevens report there handy,
Yes, sir.
could you turn to Exhibit 3, which is on page 38 of 49 in that report?
Yes, sir.
So is there, I mean, represents 5 years of financial reporting for Peak Travel Group. Is there anything that you would see in those numbers that would give you any cause to believe that they weren't reliable?
No, I mean, you started to have a downturn in 2009, which reflected in the economy and some of the stuff that went on around the world during that time. So no, to me it looks like it flows pretty reasonably, and each category flows. As your revenue drops in 2009, your SG&A has to drop in 2009. You have to adjust your business, and you'll find in our industry, and this is where I noticed the other attorney. I mean, in our industry, about 80% or more of our costs are variable. And what that means is we can take them up or down as the economy goes up or down, or as our volume goes up and down. And therefore, as your business increases, you got to take your cost up. I mean, if your business increases, you got to add more travel agents. You can't service more business without adding more travel agents. And as I mentioned, salaries are about 70% of your cost. So that cost is going to go up in a similar fashion. And as your volume goes down, because of whether it's a recession, economic something going around the world, then you have to take your costs down. And that's why your EBITDA flows at a fairly consistent percentage, because your expenses are variable and flow up and down with your revenue. So everything that I see in here, just from a cursory review, looks very reasonable.
So if you see the gross profit line,
Yep.
and that's every year it's 9.5, 9.3, 9.4, 10.2. So is that what you were talking about before as being the real revenue of the business?
Yes. That's the money that Tyler Peak, before your expenses, but that's the money that hit his bank account, and then he paid out his expenses, which then result in your EBITDA. But that's the only amount of money that flows into the actual bank accounts.
And that 9.5 or 9.3, that looks like a pretty typical sort of number.
Yeah. Based upon that, not my knowledge of their business, yeah. But again, this was all before we took it over.
Right. But, and did you say that was about what you're at Direct? That's about your percentage of the air sales, I think you called it?
Yes. Our revenue has trended around 9.5 as a percentage of air sales. Yes, sir.
So there's nothing in 9.5 in 2009 that looks fishy to you?
No.
Or in any of the other numbers in 2009 that are on this Exhibit 3?
No. nothing. And again, the expenses flow in a similar fashion, so they look reasonable too. So yeah.
I have no further questions.
Okay, thank you, Mr. Mather, and thank you, Mr. Kaufman. I'm going to see if the Franchise Tax Board has any questions for you. Ms. Kudig, do you have any questions for Mr. Kaufman?
I do, but I think that we need to, is it possible for us to take our lunch break now? I'm going to need a break, whatever, like, so, is that possible?
Let me check with
Because it's 1:00, right?
Mr. Mather. I don't know if Mr. Kaufman needs to leave.
Uh-huh.
What are your plans, Mr. Mather?
I'm not sure what Mr. Kaufman's schedule is. I'd just soon take a 5-minute break and finish up with him and then take our lunch.
Okay. I'm happy to take a 5-minute, well, maybe a 10-minute break because I have to run to the ladies' room. So I don't.
Sure, we
I
can
don't
do
know.
10 minutes and then return at 11 or no, sorry, 1:03. And then we
Yeah.
can finish Mr. Kaufman's testimony questions, and then we can take a longer break for lunch.
Okay.
Okay,
Thank
we
you.
are
All right.
going to be taking a 10-minute recess, and you're off the record. Please ensure to mute your microphones and turn off your cameras. Thank you. Okay, thank you, everyone. We are returning from a quick break. Is my panel here? Yes. Okay, and Miss Alonso, you ready to begin? All right, we are back on the record. We are turning to the Franchise Tax Board to see if they have any questions for our witness, Mr. Kaufman.
Oh, no, we have no questions. Thank you.
Okay, I'm going to turn to my panel to see if they have any questions for you, Mr. Kaufman. Thank you for your time.
Yes,
I'm going to
ma'am.
start. Thank you. I'm going to start with Judge Vassie.
Hi, Mr. Kaufman. In FTB's reply brief, they stated that appellants are putting forth a completely new asset valuation method, referring to EBITDA. Can you tell us a little bit about how long EBITDA has been used for this purpose in this industry?
Yes. So I've been in this industry for 27 years, and I even worked for Navigant, which was my first business in this industry, for a year and a half prior to me coming over to Navigant. And I was helping them with acquisitions. And in that year and a half before I came over, we did 11 deals, and every one of those used EBITDA. So as long as for the last 28, 29 years that I've done all these acquisitions, EBITDA was the only factor in those acquisitions. So I don't know how much longer before that because I wasn't in the industry.
You, Mr. Kaufman, I don't have any other questions.
Thank you, Judge Vassie. I'll turn to Judge Lamb. Do you have any questions for Mr. Kaufman?
Yes, I do. So I want to start off with that I know the Arxis appraisal stated that the Marshalls and Stevens' appraisal was unreliable for several reasons. I'm interested in the reason that they gave is that the Marshall and Stevens' appraisal used historical financial statements without any effort to normalize reported net income to adjust for non-operating income expenses. Do you have any insights into that or any reply to that?
So, just as my experience, these businesses, especially at an agency that has 287,000 of EBITDA, does not have any non-operating expenses. Again, when you look at any of those financial statements, and trust me, as I say, I've lost 200 deals and closed 150. You have salary expense, huge part of it. Then you have rent, and then you have some technologies that are required in this industry, such as the GDS, such as your phone, such as your insurance, things like that. They're really, I haven't seen non-operating expenses in deals that I've looked at. So the fact that they didn't give an example or couldn't quote an amount, that's what sort of surprised me when I was looking at their valuation.
Thank you. And what about in their report it said that see that there was an aggressive adjustment for understating debt by 951,000?
You said that they asserted that the debt was understated by 951,000.
Right.
Now, again, what I believe, and you can ask the Marshall Stevens guy as the next witness, but what he did was he reduced, as I think you heard early on in my statement, when you buy a company that does have debt, the amount that the owner's going to get is less by the amount of the debt. So you have to repay the debt from the purchase price. So if you come up with a purchase price of 1.5 million, but they've got the 951,000 of debt, then the actual price to the seller is only going to be that 710 because you have to always factor in the repayment of the debt. So that's a fairly normal process. And that again, when I saw that, I think the Marshall Stevens did it correctly by reducing for the debt.
Thank you. I'd have no further questions.
Okay, thank you, Judge Lamb. I think that concludes our testimony from you, Mr. Kaufman. We really appreciate your time, effort, and energy into this case.
Yes, ma'am. Thank you all very much for taking the time to listen.
You're free to leave
Thank you.
if you like. Yes, thank you. Okay, so let us take our longer break. I'm guessing, Mr. Mather, I'm guessing you wouldn't want to start your next witness at this point, would you?
No, I'd prefer, I think we had scheduled a half hour for lunch. Maybe we come
Yes.
back at 1:45 or so.
That's the plan, is a half hour for lunch. Does that work for the Franchise Tax Board? Ms. Kudik?
Yes, we're fine. Thank you.
Okay, then we will take a 30-minute recess and return at 1:45. Please leave your Zoom where it's at. Just mute your microphones and turn off your cameras, and we will reconvene at 1:45. Thank you, everyone.
Thank you.
Okay, we are returning from recess. I'm gonna make sure everybody's here. I see my panel and the parties. Ms. Alonso, you ready to go back on the record? Okay. We are back on the record, and we are turning to appellant for the third and last witness. Do you want to call him Mr. Mather?
Mather?
Mather, I'm sorry.
No, just teasing.
No, I
I-
apologize.
I know it's hard for you Sacramento people.
It is. It's just what comes to mind.
Yes, the appellant's called Jamie Seaman.
Thank you. Mr. Seaman, can you hear us?
Yes, I can.
Okay, we are going to swear you in before your testimony. Can you please raise your right hand? Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I will.
Thank you. Mr. Mather, you can please begin.
Thank you. Mr. Seaman, could you state your full name and your business address?
Sure, it's James Seaman, but I go by Jamie. Address is 201 North Franklin Street, Tampa, Florida, 33602.
And what's your educational background?
I have a Bachelor in Science and Finance from Purdue University.
Could you briefly describe your professional experience?
Sure. Post-graduation, kind of early 90s, I graduated with a finance degree, like I said, and I went into the banking industry for a few years. Found out that wasn't very exciting. So in 1998, as looking for a job, I applied for a position at Marshall and Stevens, and I was hired as an associate in their Chicago office then.
And what's an associate mean?
Associate is just an entry-level position, like a financial analyst. So we work with the more senior people in assisting in the projects, in the appraisal projects, building the models, helping with the report writing, and working with a senior level person being trained by them.
So was that entirely working on appraisals?
Yes, 100% at Marshall and Stevens. That's all we do is appraisals.
Okay. And so what is your current position?
Currently, I'm a managing director and principal, and I work out of the Tampa office, and I run the Southeast Financial Group.
So, and you've been with Marshall and Stevens the entire time?
Not the entire time. There was a brief stint around 2006, 2007 that I left for another position to be a director at a small accounting firm in Chicago. And after about a year there, the gentleman actually hired me in Marshall and Stevens, left Marshall and Stevens, and we both started a evaluation practice at Kroll in their Chicago office. We were there up until the beginning of 2009, and we both returned back to Marshall and Stevens at that point, and I've been with them ever since.
So have you been essentially working on appraisals or business valuations this whole time since you started with Marshall Stevens originally?
Yes. In various, like I said, at the beginning you start out as an associate, but you're in the mix of doing the appraisals, and you just work your way up and to the manager, director, and managing director level. But yeah, it's been appraisals the whole time.
So what certifications do you have?
I am an accredited senior appraiser, so I have my ASA through the ASA, which is the American Society of Appraisers.
And what do they do?
The American Society of Appraisers is our society, our group, our association. It's a multidiscipline association. So you have the business valuation group, which is where I fall under, but they're a multidiscipline firm. They also have tangible asset groups, commercial real estate, gems and jewelry, but they do most of the education and credentialing for the appraisal industry. They've been around. They're the largest and longest standing appraisal association that there is.
And what did you need to do to get that certification?
To get the ASA,
Yes.
it's a long process because it requires experience along with other factors. So it's about a 5-year process in total. So you start by doing coursework. You have to take within your discipline certain courses. And in my case, it was 4 business valuation related courses, which are about 4 days long with a proctored exam at the end of it that you need to pass. And that usually takes, because of them being offered, maybe a couple years to get through those courses. And then you have to pass the USPAP exam, which is the Uniform Standards Principal Appraisal Practices. And then you have to pass an ethics exam. So once you go through all that and you have 2 years experience in the industry, you get your accredited member designation, an AM designation. And then from there, once you reach 5 years worth of full-time appraisal experience, you can then apply for your ASA, your accredited senior appraiser. And in order to do that, what they do is they do a peer review of some reports that you've prepared. So those have to go through a kind of a local, the local chapter peer review where they review your reports. Then they do an interview. They check your kind of professional references on top of that. And then once they approve your reports and you've hit that 5 years of experience, you can then get your ASA.
Okay, so I'm a little confused. So ASA is the organization and it's also the designation?
And it's the designation. So the designation is Accredited Senior Appraiser. The organization is American Society of Appraisers. They're both ASA.
Ah, okay. And so how long have you been an ASA?
I've been an ASA since about 2003, 2004. So approximately 20 years.
And there's nothing more senior than senior, I guess. So
yeah, I mean, they do have fellows in the organization also, but those are more kind of distinguished type titles. They're nothing that you can actually work towards, like from an education standpoint.
So when you say that you're doing financial analysis and valuation, is it always for a third-party client, or is there other things that you work on as well?
99% of the time, it's projects that I'm working for other individuals, where they're doing some tax planning, some estate planning. We also do a lot of work in financial reporting with valuations. I do a little bit of work with our sister company, which is called MS Capital. They're our investment banking arm. They do a lot of representing of sellers in their businesses, and we get a lot of those from wealth managers that we kind of deal with. And for them, I provide them some support in doing what we call calculations of value for their clients. It's not a lot. Like I said, it's probably 1% of my time that I work with them, but I do work with the MS Capital Group and helping them essentially establish some due diligence valuation work around potential deals.
So but that's still essentially valuation work?
The process is valuation work, but it's not an opinion of value. We go through the same methodologies as we typically would for standard business valuation, but there's some just agreed upon terms that they're not considered opinions of value when we give them to the client, because they provide a range of value so that MS Capital can then take it from there, work with their client to develop, are we going to go through the process of trying to sell the business or not? So they're not full opinions of value, but you go through pretty much the same methodologies to get to the range of value we provide.
So I guess you heard Bob Sweeney's testimony earlier. Is that on a much larger scale, kind of a similar sort of thing, assisting the seller in determining at a range of value?
Yeah, I would say that MS Capital portion of the is pretty similar. I mean, we're looking at the financial information that the potential client has. Now, these people have not engaged us to do valuations and provide opinions. We're getting the financial information, building out models, and doing kind of ranges. So again, we'll look at here's the company's EBITDA, here's a range of multiples based upon this method and this method, and coming up with kind of a value range for that then our MS Capital team can take and then say, here's our estimate of where we can be at. Let's fine tune this. And sometimes they turn into full valuations for other purposes, but a lot of times it's just for their due diligence work. And again, that's not a huge portion of what I do.
Are you familiar with valuations of the travel business?
I would say as a whole, I'm a kind of a generalist. So I do work across many types of industries, all types of industries, retail, manufacturing, biotech, information tech, all that kind of stuff. But I have done travel businesses before. But really the methodologies and approaches in valuing a business are pretty much the same across the board.
So what are those methodologies? I mean, how do you, in general, approach business valuation?
Yeah. When you're appraising anything in any business, there's really three approaches you can look at: the cost approach, the market approach, and the income approach. Now, the cost approach is just that. What does it cost to recreate this asset? That's not very applicable for a going concern business like Peak Travel or any kind of company that's, a cash flow generating business. So then we really rely on, for most operating businesses, looking at the market approach. And there's really two methods under that market approach. You can look at guideline transactions, and that's the actual sales of companies. And then we can look at guideline public companies. And those are publicly traded companies where we pull down their financial information. And as of our valuation date, what is that company selling for right now? What is its stock price? And based upon that data, we can, again, calculate multiples from that information that we can then apply to our subject company. And then the last approach is an income approach. And really, there's a couple methods under the income approach you can use. If you got a business that's pretty stable, not projecting any kind of serious growth or something like that, you could do a capitalization of earnings if the earnings are pretty stable. Or most of the time, we do some type of a discounted cash flow analysis where we're looking at future cash flows and then present valuing those cash flows to today through some kind of rate of return.
So you've heard us talk about EBITDA all day long so far. So how does EBITDA factor into those methods of appraisal?
The EBITDA really comes into play from the kind of the multiple standpoint. When you're looking at guideline transactions, we do a search for guideline transactions in the industry that we're looking for. A lot of transactions are private, so they don't publish a lot of data relative to that. But there are certain areas where you can get some information relative to what kind of multiples are being traded. So we typically look at an EBITDA multiple because it's, again, like it's kind of been stated, it's representative of a company's cash flows. And that's usually what an investor is concerned about, is what is the cash flow generating capacity of this business, so that, they can kind of look at a valuation based upon that. And same thing within the guideline public company method. We use that information to develop those multiples that we then can apply to the proper metric. And in most cases, it's an EBITDA because, again, that's what investors are concerned about.
So is the EBITDA used in the discounted cash flow method, or is it a different number that's used?
It's a little bit different in a discounted cash flow method. I mean, you're calculating your cash flows up to an EBITDA standpoint, but then your discounted cash flow method takes into account investments in the company and working capital, investments in capital expenditures, to really come up with kind of what's that free cash flow distributable to the shareholders. And that free cash flow is then present value to today to come up with your value indication.
Okay. Could you turn to Exhibit B, which is report you did for Peak?
Sure. Okay.
So you are the person that prepared this report, or principally, correct?
Yes.
And when was the report done?
The report was issued in January 26, 2015. So that would have been the report production date when we issued it.
Okay. And but that was not the valuation date. Or
No, the valuation date was November 1, 2009.
And what were you asked to do in this engagement?
We were asked to value the total equity of Peak Travel.
So that's the total equity. So what does that mean?
Yeah, that's the total equity is the fair market value of the equity. So what we do when we're doing our business valuations, we do them on a debt-free, cash-free basis. So the value indications you're coming up with EBITDA is really the value of the total invested capital of the company. So you're stripping out anything relative to how a company is capitalized, things like that. So when we come up with the value of the total capital, that's the debt plus the equity. So to get to the equity at that point, you make any adjustments for cash and non-operating assets, any working capital adjustments if required, then you subtract the debt, that's your final equity value. So
Okay.
EBITDA is going to get you to the enterprise value, and then you make your adjustments and subtract that to get to the equity value.
So that the enterprise value is the fair market value of the company, ignoring debt. It's debt or it's other. I see.
Right. Exactly.
But then the equity value is what is presumably the value you could sell it for?
It's you can almost look at it as like a proceeds type value. We have the business value, let's say at $1 million, and say there's 100,000 of cash and non-operating assets. We're at $1.1 million, and there's 500,000 of equity or of debt. You subtract $1.1 million to the 500,000, and then you're left with 600,000 of equity. So it's just like any other thing. If you own a home and it's worth 500,000, you have 300,000 in debt, you have $200,000 worth of equity. So if you sold your home, your proceeds would be that 200,000 because you have to pay off debt.
So in this Exhibit B, what was the final value that you determined as a result of the analysis?
Yeah, came up with a total equity value of $710,000.
And could you kind of take us through some of these pages and exhibits and see how the principles you described are evidenced in the report? Well, let's start with, let's see. Well, you I'm going to say it wrong, so why don't you just explain it?
Okay. I mean, really, if you look at the report in the in the back half of the report, there are exhibits: Exhibit 1, Exhibit 2, Exhibit 3, Exhibit 4. Exhibit 1 is a summary of the whole analysis. So everything that's done from Exhibit 2 and on is summarized in Exhibit 1. So what we do is we come up with a value of the business enterprise, which is the debt plus the equity through each of the methods. So we did under the transaction method, the guideline company method, and the income approach. And all three of those correlated pretty well. Because when you're looking at multiple approaches, you know, if you have any kind of outlier valuation indication, you really need to double check some of the assumptions that are maybe utilized in all the different approaches so that, you know, in the end, they kind of reconcile relatively closely. So in Exhibit 1, you can see we came up with the value range between the three approaches. And then based upon our weighting, we looked at each one of them equally. We came up with an unadjusted enterprise value of $1,470,000. So that's your debt plus your equity before any kind of working capital, non-operating assets, things like that. So then all you do is, if there's any working capital adjustment that gets taken, in this case it was 70,000, we add back the cash and the non-operating assets off the balance sheet. That's 835, and then you just subtract the debt to come up with the equity value.
Okay, so is it, so the $1,470,000 is the value of the projected future income?
No, in this case, the $1,430,000 under the income approach, that's the value of the projected income. So that's using the discounted cash flow analysis. The other two methods, transaction and guideline company, are where we're developing multiples and applying them to the company's EBITDA to come up with a value indication.
Which is also an earnings-based
Yes.
formula.
Right, because we're using EBITDA as the basis of the analysis, right?
And so the ones lower down the page then are the balance sheet items that would vary from company to company, I guess.
Correct. So we've taken cash out of it. You just add the cash back since the whole analysis is debt-free cash. And the other assets are considered non-operating. So when you're looking at the value of a business, you know, if you got working capital, fixed assets, and everything else, intangibles and other. This analysis, the first portion of the analysis, takes care of the working capital and the tangible assets. If there are any other assets that aren't included in there, those are considered non-operating assets and added back. So there was a loan to a stockholder that was added back directly because that's really a non-operating asset. It's just stripped out. And cash surrender value of life insurance. Again, another non-operating asset that's not in the working capital. So we need to account for it. So we have to add it back.
And then similarly, the debt is subtracted out, I guess.
Right.
Because there conceivably could be a company that has the same EBITDA and the same discounted future cash flow that has none of these items.
Right. Exactly.
Okay. So, all right. So then you have the three approaches. Where does that come from? Where does the $1,435,000 come from, for example?
The $1,435,000 is under the guideline transaction approach. So within that report, Exhibit 4 and Exhibit 5 are the guideline transaction approach.
Okay.
So Exhibit 4 is transactions we found out of the Capital IQ company database. That's the database we subscribed to at the time. And we were able to find two transactions that actually published the financial metrics that we could use, in this case, EBITDA. Because again, a lot of times transactions don't publish all the information. And in this case, we found two that traded an EBITDA multiple of 4.5 and 5.3. We selected 5 as the final multiple to apply to our company.
Okay. And then Exhibit 5. What do you do?
Exhibit 5 is where we apply that multiple. So we look at the company's EBITDA, which their latest fiscal year EBITDA, which is the most recent EBITDA, was $287,000. We multiply that by 5, and then we came up with the value indication of $1,435,000 under that approach.
So the 287, if you turn back to Exhibit 3, where does that come from?
This comes from the company's financial statements. It's their 2009 EBITDA.
Okay, at the adjusted EBITDA number, kind of at the,
Right. Yeah, it's the most recent EBITDA from their 2009 financial statements.
is there, so this is, and where, pardon me, where did you get the information on Exhibit 3?
The company provided all the financial information to us.
And so that's 5 years, I guess.
Mm-hmm.
Is that,
Right.
do you take into account the earlier years?
Sometimes you do. It depends on the type of company and the industry. I mean, mainly what we're looking here is more kind of trends. You know, first of all, the company's been profitable for 5 years. So this is definitely a going concern analysis. And from an investment standpoint, they're generating positive EBITDA. So that to us is going to be the best value indication for most operating businesses like this is, you know, what kind of cash flow are they producing? And in this case, you know, under a market approach, we look at the EBITDA for that.
And it looks like in almost all of these years, it's the EBITDA is 0.3%, 0.3%, 0.3%, 0.3%. So that's pretty consistent, it seems.
Pretty consistent, yeah. Yeah, and it's kind of like John was talking to, you know, a lot of this business, the expenses are variable. So you can adjust on the fly kind of as, you know, revenues are increasing or decreasing. You know, when you've got that high level of variability, you can adjust to maintain that same level of kind of profitability. In this case, you know, kind of the 0.3%.
So based on this five-year history, that 287 looks like a pretty solid number, I guess. Is that fair?
Yeah, I mean, when you look at the overall 5 years, that 287 looks like a pretty standard number, a pretty well-established, you know, not necessarily average, but kind of where the company typically is from a profit standpoint.
So you're the testimony of Bob's 2.5 to 6 range, generally speaking. Is that kind of information anything that you factored into this particular part of your analysis?
I would say our analysis, it doesn't necessarily just rely upon that. I mean, we do our own independent analysis trying to find third-party transactions like we did in the transaction data. There it indicated 4.5 to 5.3 times. And we looked at guideline public companies. And in that case, I think our ultimate selection was kind of in that 5 range also. So it does fall within the range that Mr. Sweeney was talking about. And for companies like this, you know, kind of established company like this, I think that multiple range makes sense.
So 5, just in general, irrespective of the travel business, would be kind of what you'd expect for a mature business like this?
For a business of this size, you're probably looking at, again, range. From my experience, for a typical company, maybe a 4 to 7 multiple. Again, you know, we have some nuances in this travel industry that obviously Mr. Sweeney and John talked to from real world experience about their experience in the range of multiples that are paid in this industry. I think our data is kind of independent, but still kind of supports that we kind of fell within that range that they are talking about.
These 2 transactions in Exhibit 4, was that a reasonable number for you to draw on?
I would say it is because they were reasonably close in range. Again, finding transaction data of published company that companies publish so you can compile full data it's difficult, but the ones that we could, you know, are kind of pointing in that direction of that 4.5 to 5.3. And in this case, you know, the 5.3 was a much smaller company in enterprise value, but we still kind of dialed back the selected to a 5. So it fit within the range of the transactions and seemed reasonable.
Okay. And so the 1,435,000 we saw comes from the mathematical formula on Exhibit 5.
Yeah, it's literally just applying the selected multiple to the latest fiscal year EBITDA.
So the next number then on Exhibit 1 is $1,550,000 for the guideline company method. Where does that
Yeah.
come from?
The guideline company method starts on Exhibit 6, but I mean, really, you get into the crux of the analysis on Exhibit 10. And on Exhibit 10, so these are the guideline companies we looked at within the industry. Now, remember, these are publicly traded companies, so much larger, more diverse, maybe geographically deeper management in most cases because they are public companies. So these are the actual EBITDA multiples of each of these companies as of our valuation date. So we look at them, and based upon this, we select a kind of a baseline EBITDA multiple.
So the financial information for these companies then is audited financial statements that are published.
Correct. This is all public data that would be in their 10Ks, 10Qs.
Okay. So then, so you came up with 9.0, I
Right.
guess. And so what modifications do you make for that then?
So when you're looking at, again, when we're looking at this data, these are much larger publicly traded companies. So we need to adjust this multiple to make it more the size of a closely held company, and then the size of that closely held company. So you can see on Exhibit 11, we have the same EBITDA, 287,000. That selected multiple of 9 from the Exhibit 10 that we started with. And then we make what we call a discount for size, diversification, management of 40%. And so the adjusted market multiple we're using out of the guideline company method is that 5.4.
So where does the 40% come from?
That 40%, the support for that comes from, if you go to the next exhibit, Exhibit 12. So what this is data out of Houlihan Lokey, and what it does is it compares PE multiples of large companies to small companies. So based upon that differential, we call it a size discount, even though there's probably more that kind of goes in. It was basically adjusting the multiple from these large publicly traded companies to what a smaller company would sell for. So if you look at the data here, small versus large companies, we look at a 10-year period, and 100 million or more in, let's say, 1998, they were trading at PE multiples of 24.2 on average, the companies. 25 million or less, so that would be the small company size, we're trading at 12.6. So there's an implied discount for size of 47.9%. We look at this over a 10-year period, and then we apply, our adjustment to that multiple based upon, what we know about the company, the industry, and this data. So this data supports, those discounts anywhere from, 25 to 40% typically.
Okay. So that's the 1,550,000 number. And then the other number on Exhibit 1 was 1,430,000. Where does that come from?
So that's the other approach we use. That's the income approach, and that's the discounted cash flow analysis. That's presented in Exhibit 13. So what we're doing here is management would provide us projections of future cash flows, future revenue, future margins, and looking at the projected cash flow for the next 5 years into the future. And at that point, we cut it off and pretty much say that they're going to grow at a long-term growth rate from that period going forward. That's the terminal period at the end. So all this is doing here is if you go kind of 2/3 way down the line, your profit before income taxes, that's your EBITDA line. So year 1, 230,000. Then you make adjustments for tax affecting that, make adjustments for any capital expenditures. They may need to buy new computers, things like that. So we're coming up with a free cash flow in year 1 of 165,000. And then that same methodology carries forward, and then we present value all that back to today, because a dollar 3 years from now is not worth a dollar today. So we present value that back at what we're considering the investor's required rate of return.
So that is based more on projected future earnings than historical earnings. Is that fair?
Correct.
And you said that the cost approach didn't apply, so there was no other method that you applied in this?
No. We applied the 2 approaches and then 3 methods in total: guideline transaction, guideline public company, and income approach.
But they're all fundamentally based on earnings.
Correct. Yes, because the market approaches, we used EBITDA, and the income approach is forecasted free cash flow, or EBITDA.
And why not revenue?
Well, I mean, when you have an established business it's just based upon my experience. EBITDA is the driving factor in most valuations. It is in a lot of the valuations I do. I do a lot of work for in the mergers and acquisitions of private equity companies, where we do the financial reporting, where we value all the assets after a deal is done. I see a lot of private equity valuation models of them pricing a deal, because they need to provide those to me once the deal's done. And in those models, there's always some sort of discounted cash flow analysis, and there's always some sort of metric of EBITDA, whether it's in the exit multiple or, here's the purchase price, here's the company's EBITDA, we're paying X times EBITDA for it. So that the revenues never come into play in an investor's decision like this. It's always going to be the cash flow, because that's how you get paid back. I mean, your future cash flows is how you're going to service your debt. Your future cash flows is, what could be distributed to shareholders at the end of the day. It's not the revenues.
And you heard John Kaufman say that, ultimately this is willing buyer, willing seller. So is that fundamentally what you're trying to determine in any valuation?
Yeah, we go by revenue ruling 5960 and the definition of fair market value, and it being a willing buyer, willing seller, neither other under compulsion to buy. So it's really kind of that middle ground area of valuation. So you always got somebody who wants a deal. You always got somebody who wants, to get paid too much for their business. Ours is a willing buyer, willing seller scenario, where it's like, we've matched up the valuation to those that are selling and those that are buying. This is a reasonable value, and that's the fair market value.
Now, if you could turn to Exhibit G, which is the Robert Jocelyn valuation.
Here somewhere. Okay, got it.
So this was done in 2008, so it's obviously it's a current valuation, but what method did Jocelyn use here, and how does that relate to the methods you applied in your report?
Yeah, the main method used in here is a multiple approach. So it would be a variation of the market approach. Anytime you're using multiples, that's going to be a market approach based valuation. And kind of the range of multiples that, he described as being relevant to the industry, and then his opinion as to what multiple would be applicable specifically to peak. So, but it's ultimately just a cash flow multiple.
And he referred to it, and I couldn't find the term this morning, and I'm missing it again. It's something like before cash flow or forward cash flow, or
yeah, I think it was the pre-tax cash flow.
Before tax cash flow, yeah.
Before tax cash flow.
Yeah.
So that's pre-tax cash flow. So EBITDA is earnings before interest, taxes, depreciation, and amortization. So that's EBITDA. So pre-tax cash flow would essentially be the same thing because EBITDA, the DA, depreciation and amortization of EBITDA, those are non-cash expenses. So you deduct them for tax purposes, but they're actually non-cash. That's why those get added back. That's the DA part of EBITDA. The T is the taxes, obviously. The I is interest. So earnings before interest, taxes, depreciation, and amortization. That's what you have left to service your debt, service your interest payments, pay your taxes, invest in the company through capital expenditures or any working capital needs you may be. And then everything after that is what's available to the shareholders.
Okay.
So it's a measure of free cash flow.
So he wasn't calling it EBITDA, but it's something basically the same.
If cash flow would always kind of indicate what you kind of have left over, which would include depreciation and amortization, because those are non-cash. So although it's not specified as EBITDA, that terminology implies an EBITDA because it is a free cash flow.
So this is obviously a little less comprehensive than yours, but do you think that this provides a reasonable valuation of the company?
When I reviewed it, yeah, I do believe it did. I mean, obviously, they have some significant experience in traveling agencies and kind of what they're selling for. Looking at the multiples selected, they didn't seem completely out of line. There's some, other pieces of it where there's just a little bit of missing data that I wouldn't be able to track, kind of perfectly. But to me, ultimately, it's, what's the basis you're using, free cash flow, and what multiple are you applying to that? And, based upon the kind of the multiple they're applying here, it didn't seem unreasonable.
So, but I guess would one of the main differences, at least with respect to the multiple, be that you did it based on transactional information and he seems to kind of use it based on his volume of experience?
Yeah, I would say that the main thing here is, it's a pretty short report. Obviously, the multiples seem to be within the range, but our analysis is just a completely independent third-party analysis where we presented the data we had, and you can kind of walk through it step by step and see how the data, where we got it, then how it's applied, what it's applied to, and then what the ultimate value is based upon that.
Right, and
A little more comprehensive.
And to the extent you can tell, he's kind of coming up with his multiple based on his experience in the industry, it seems.
Right.
Yeah. So that's fundamentally different than what you did.
Yeah, our analysis is, again, just kind of a completely independent, willing buyer, willing seller, third party type of analysis, where he's providing an opinion kind of based on his experience. He even states here, current experience with travel agent are actually selling for. So I think that's more of kind of what this analysis is.
Right. Now, could you turn to Exhibit 11, which is John Kaufman's declaration?
Yep, got it.
And some of this was covered by John's testimony also, which you saw, but he references being involved in 150 transactions. Does that seem like a adequate sample size to get some sense of what the industry transactions are?
I would say absolutely. I mean, in the world of valuation, I would say if you've done 150 valuations of one specific industry, you would be considered an industry expert in that particular industry.
And in paragraph 7, John mentions a range of EBITDA multiples of 3 to 9, and I think in his testimony he said, well, rarely over 6. Does that comport with what your findings were?
It definitely does with transaction data. Like I said, we're at 4.5 and 5.3 were those transactions. If you look at the guideline public company method, we selected a 9. That's a publicly traded company multiple that we're selecting there. So that's the high end of the range. And again, he's dealing more with closely held companies, smaller companies. So that 9 seems to be an outlier from a closely held company standpoint. From the public company data that, we're kind of presenting in our report, that's probably kind of the median average in that subset.
Now, in paragraph 9, John refers to the Ambassador transaction, which he computed to have a EBITDA multiple of 2.7 and had explanations for why that might be lower than normal. Does that,
Right.
did those explanations sound reasonable to you?
Yeah, because when we're looking at valuations, and especially even in the world of private equity, they're going to want to pay for a higher multiple for growth. What can we take this company and expand it to? How can we expand it? If something's very established business and just kind of continue on in the same path it's at right now with the same level of growth, same level of profitability, there isn't that upward expectation that you would want to pay a higher multiple for. So it sounds like from his explanation, this business was in a niche business. There was an opportunity for them from a synergistic standpoint to make any improvements on top of that. So it's, almost like just kind of a fold in of a typical add-on acquisition where, we're gaining more EBITDA out of this business, but we're not going to pay an exorbitant multiple for that.
And I believe that in the Jocelyn report, he used a 2.5 multiple ultimately, so that's not far off either.
Right.
And now in part 10 or paragraph 10, John refers to the peak sale to direct travel, which was later, several years later than your valuation, but I guess around the time maybe that you did it. Is that something that you should have taken into account in your report?
I would say no, because we're doing a valuation as of a specific valuation date, November 1, 2009. So in the world of valuation and appraisals, the standard is what's known or knowable as of that date. So if we know something's happening 3 months later at post our valuation date or did happen, if it was kind of known or knowable as of that valuation date, then yes, that can be considered. But you're talking about a transaction that happened 5 years after the valuation date. The company is completely changed in that amount of time. That is something that would not be considered as of my valuation.
Now that transaction, I think, had a EBITDA of 5.9, so
right,
still in the ballpark, I guess. Huh?
Right. Yeah, I mean, when you look at it, kind of our ultimate EBITDA applied, it was probably in the 5 range or so. So same thing. So I mean, over that 5-year period, they grew the business, they grew the EBITDA. They didn't necessarily grow the multiple very much from a sales standpoint. So again, not reasonable to use that as a benchmark value in an appraisal 5 years prior to that.
But the EBITDA was not quite 10 times what it was at your valuation date. Would you expect a multiple to be higher if the EBITDA was that much higher?
Not necessarily. I mean, it's just a higher EBITDA at that point. Have the fundamentals of the business changed to where it would, warrant paying a higher multiple than in prior years? I mean, they did pay a higher multiple. I mean, a 1 times multiple is a pretty good increase off of a 5 multiple. So they did pay a higher multiple in that, subsequent transaction. But again, I wouldn't say it would have any bearing on, a valuation I'm doing as of 5 years prior to that.
Right.
With a completely different financial mix in the profitability.
Right. But just in general, you mentioned before when you were talking about the I can't remember what it was called, but the public companies, bigger
Mhm.
public companies had a higher multiple. So would that apply in this range also, or not necessarily?
No, not necessarily, because again, those are publicly traded companies. That's data coming right off, their stock price and their financial metrics. You're still comparing them to a closely held company, even though that company's EBITDA grew 10 times. It's still not even close to the size of what those public companies would be as far as profitability, revenue, anything. So to me, there wouldn't be a big adjustment in the multiple for that.
Would the income stream reflected in the EBITDA be more reliable if it was bigger, or is that a conclusion that's hard to make?
It's hard to make. I mean, I will say that the larger the company, the more scrutiny it goes through on its financials, especially if it's like getting an audit or something like that. I believe Peak Travel had compiled financial statements by an accountant. So that's better than just an internal QuickBooks statement printed off. So, there was a little bit of scrutiny done in the compilation of the financial statements, but the larger the company becomes, more their just accounting systems get more updated. Yeah, there's a higher level of scrutiny if you're going through an audit. But ultimately, yeah, at that size, it still isn't kind of the size I'm talking about where you'd start to go through that heavier level of scrutiny.
Okay, could you turn now to Exhibit 12, which is Bob Sweeney's statement?
Okay.
Now, did you know Bob Sweeney before this case?
No. Nope.
So he says his firm has been involved in 660 sales in the travel industry. Is that enough to make him a credible authority?
I would say absolutely yes. I mean, you've got that much experience, you're involved in that many actual sales of companies. First of all, the level of data he would have by being personally involved in that is beyond anything that any valuation analyst would have. I mean, he's got all that private data himself since he executed those transactions.
Right. So, and his EBITDA range is 2.5 to 6. So that sounds reasonable also?
Yeah, it's like I said, still falling within the range we used for peak. It looks like it's falling within the range that actual transactions were, done by with, journeys and with direct travel. So it doesn't seem unreasonable, that range.
And he says that EBITDA is the absolute driving force behind any reality-based evaluation. Is that also a reasonable statement?
I mean, I would agree because again, investors are concerned with cash flow. That's how you get your return. It's in the end, we have revenues of X, but what is my cash flow that I can use to continue to run the business, to service my debt, and have something maybe distributable to shareholders afterwards. And then if I pay X, how long is it going to take to recoup that investment? So, most private equity firms, based upon my experience, they're going to want holding periods anywhere from 3 to 7 years, with the average kind of being around 5 years. So if you're paying an EBITDA multiple of 10, 15, 20, there's no way to recoup that investment within the, standard holding period that you're going to hold most of these investments.
Excuse me, Mr. Mather, we're coming up on an hour here, just to give you a time frame.
Right, but I haven't used my 2 hours before, so that's what I said up front, that they wouldn't all be equal. So the first one was closer to a half hour. So if I can be granted some leeway.
Well, are you still planning for an hour for your closing arguments?
Less than 15 minutes.
Okay, then we can use a little of that time.
Okay, thank you. So now I'd like you to turn to the ARCSIS report, which is Exhibit C.
Okay.
All right, if you could go to page 9. this is the CV of Chris Hamilton, who prepared this report. How would you compare your qualifications to Mr. Hamilton's?
Well, he has nice qualifications, but I would say that, he has a CVA, which is Certified Valuation Analyst, but he's also a CPA and a CFE, Certified Fraud Examiner. So, as far as amount of time spent between the three different kind of practices, I would say that my experience is 100% appraisal valuation related. I don't have a CPA. I don't do any tax work, audit work, anything like that. Any, forensic accounting work. It's 100% business valuation where, he obviously has other designations and other areas where he spends his time, on projects.
So what is a CVA?
It's a designation through NACFA, which is the National Association of Certified Valuation Analysis, which I believe has fallen under the AICPA, which is the guidelines for CPAs. And so the CVA is a designation that they give through that organization primarily to CPAs. So you can be a CPA, certified public accountant, and say, all right, I want to do valuations too. I'm going to get the CVA designation also through my association. So it's just a different association, and it's not as stringent, especially if you have a CPA to get, because if you have a CPA, you're kind of almost granted that through a much less robust process. I believe it's like you have to submit one report that you've completed within a 12-year period and take one 5-hour exam, and you can get the CVA. Where, I do valuations, and I have my ASA through the ASA, and that's, like I said, a much more rigorous process, and all my time just spent doing valuations.
So it's as you understand it, a specialization designation for CPAs?
Exactly.
Now, if you could turn to page 1. In the second to the last full paragraph, it references tangible value of $293,000 and intangible value of $8,707,000. What is tangible and intangible value?
Well, what he's referencing here is, the value indication being 9 million. If you look at the stockholders' equity as of the valuation date, it was 293,000. So where's the rest of the value in that 9 million? It's all in the intangible value, he's saying. So intangible value being goodwill, customer relationships, things like that. So it's a really high kind of ratio of intangible to tangible value. We know there's not a lot of tangible value in these service companies like this, but the intangible value there seems abnormally high relative to not only that, but not only to the earnings, because intangible value, that's all supported by excess earnings. So when you're looking at intangible value, let's say that covered customer relationships, which I value as part of financial reporting. That's all done on the excess earnings of the business. So if you don't have, all those earnings to support that value, it just doesn't make sense. So really, even though you're kind of breaking these two out, that intangible value has to be supported by earnings.
And was there any evidence in the ARCSIS report that it was supported by earnings? I mean, an actual computation based on real earnings?
No.
So
what did earnings approach?
Yeah. So what did ARCSIS use as their method?
ARCSIS used a price to revenue multiple as their only indication of value.
And where in the, well, let's see. Let's turn to page 36 of the report, the ARCSIS report, Exhibit C.
All right. There.
So how does this explain how ARCSIS came up with its value?
So this is information out of Deal Stats, which tracks private transactions. So these are like brokers who are selling businesses like Mr. Sweeney, but they actually give the data to this Deal Stats to kind of build a database of private transactions. Now, again, it's not all encompassing at all whatsoever. And a lot of the data and these kind of things are missing because you could see certain factors are just not reported for it. So what he's doing, like if we take, for example, the very first one, he's taking, the net sales amount of 2 million and dividing that by the market value of invested capital, it comes up with a invested capital to sales ratio of 0.04. So he's looking at all those invested capital to sales ratios and determine, okay, what do I want to apply in the case of Peak? And in this case, he took 0.12 of revenue. But again, you're kind of mismatching to me the data because he's applying it against the gross revenue of the company, which we've been through that they don't collect that money at all. They don't even see it flow through their bank account. The actual revenue of the company is that net amount, which is closer to that $9 to $10 million a year. So if you take that same multiple, which is based off of net sales and all these transactions, you'd end up with, considerably lower value in the kind of million, right? If you apply the same 0.12 multiple, kind of in that million two range for a value.
And would that then be adjusted for the assets and liabilities?
Yes, because this is a market value of invested capital multiple. So that once the value you're determining for that 11.4 million is both the debt and the equity. So then you'd have to subtract the debt for that. It's just the application of this multiple to the company's gross sales isn't appropriate.
Okay, so he basically applied the factor to the wrong number.
Right.
And I think you just said, but I'll repeat it. And if he had applied it to the right number, then he's in the ballpark of us.
Yeah, if you take that 0.12 times, let's say 10 million, you're at $1.2 million at that point. So still a little lower, but
one of the things that I see is that in the kind of the highlighted line MVIC to net sales, it has a range of 0.04 to 0.83.
Right.
Is that a reliable indicator if it's got a range of 20 times?
in the valuations that I've performed, sales and sales multiples are really not applicable to almost all businesses, because if you're going to apply a price to revenue or a price to sales multiple or a revenue multiple, there's certain valuation steps and theories you kind of need to go through to see if that's even applicable. Typically what we do, and this gets a little bit kind of technical, is we'll run a regression analysis where we look at price to revenue multiples of our transactions or guideline companies and compare them to a profit margin, which is typically EBITDA. You run that regression analysis, and if there's a good correlation between the two, then maybe a revenue multiple might be applicable. 99% of the time, there is no correlation, and it's just not an applicable multiple. So that's why EBITDA is the driving factor in almost all valuations, because it's a reliable multiple. There's no mixing of theories within it. There's no correlation between other multiples like you would with a price to revenue multiple. So first of all, just the application of that multiple isn't appropriate. And here you have a wide range of multiples. And again, if you look at kind of the size of the companies and everything else, there doesn't seem to be any correlation, and you really can't do that correlation because there's just not enough profitability information in here to do that.
And was there any indication that in the ARCSIS report that they did any kind of that regression analysis to see if it was a worthwhile factor?
No, it just says they looked at these range of multiples and selected the harmonic mean as being the appropriate one to apply.
And what's the harmonic mean? Do you know what that is? I've never heard of it
To
before.
be quite honest, I'm not familiar with what a harmonic mean is. Typically, we're looking at, in our analyses, we're looking at high, low multiples, average, medians, and then 75th and 25th percentiles. That's the range of multiples we'll calculate, and we'll be able to determine something off of that. The harmonic mean, I'm not familiar with at all.
Maybe it sung to him.
It could be.
So he had also indicated that these were the only 12 transactions in the recent time frame, the latest of which was a couple years before the one at issue. We heard this morning that there's hundreds of travel agency sales during the year. What would account for the fact that he could only find 12 and none of them were close in time?
Right. Well, that's the limitation of these databases, and there are limitations for us too. But, especially with the deal stats, because those are private. Those are private transactions. Obviously, we just heard there's approximately 700 a year, yet you can only find 12 of them over a decade period because all those transactions aren't being funneled and reported to this deal stats database. It's brokers who have relationships with deal stats who are doing these transactions and providing the information. I don't know if they get paid for it, but they're providing the information. So there's just a myriad. There's, if you look at 700 and you found 12 over a 10-year period, that means 98% of them aren't even being reported through a database.
Now, one of the other things that the ARCSIS report says is that they had incomplete information to do some part of an analysis that they preferred to do. Does that seem like a rational excuse?
Well, I think it's, they did one approach. And again, when I'm doing evaluation, I want to do as many approaches as possible because they sanity check each other. They cross check each other. When you look at transactions and guideline companies and an income approach, when you kind of pull your analysis together, they should make sense. Otherwise, if you have a standalone approach and you're selecting one thing, you have absolutely nothing to sanity check that against. But in this case, his report does show, our exhibit that has 5 years of historic financial statements, 5 years of historic EBITDA. You could have just done a capitalization of income approach based off of that. Even if you didn't want to do a projected thing, that's where you look at the company's historic EBITDA. You come up with kind of what you think the average EBITDA be. And it may even be the current 287, but let's round it to 300,000. Then you come up with you build a required rate of return. And all you do is you take that number divided by that required rate of return. That's your capitalization of income. You get a value indication based on that. That at least would have provided a sanity check. So if you've got a $300,000 EBITDA and let's say a 10% capitalization rate, it's just like Shark Tank. That turns into, a $3 million value indication. So not even that. And then you would compare that to your transaction approach at 11.4 million and go, wait, my earnings are not supporting this multiple approach that I'm doing over here. What's going on? They don't make sense. They don't correlate very well. So I think the information was there to at least do an approach like that.
So the
A secondary
failure to do
approach.
that, did that, in your view, prevent this from being a credible valuation?
Yes, I believe so, because it's just you can't look at one thing on a standalone basis. When there's data out there, and there was data in here, financial data, that you could have done a secondary approach, again, to cross-check, because you may have saw, oh, well, this indication's coming up based upon a capitalization of earnings of $1.5 million, $2 million. Why am I getting a $12 million indication out of my market approach? And to me, it's on the market approach, it's because of mixing apples and oranges on the basis that they apply the multiple to.
So the value, as we said, is 11.4 million, the enterprise value before adjustments. and the EBITDA was 287,000. What's the rate of return or the payback or the ROI or whatever you want to call it on that?
Yeah, I mean, you're looking at, a multiple of about 39, 40 times EBITDA at that point. So when you're looking at rates of return, you're looking at kind of the inverse of that. That's about a 2.5% rate of return on your investment per year.
And
So
so I
that
guess,
isn't,
yeah.
I was just saying, because that, as an investor, am I going to invest $11.5 million for a 2.5% rate of return based upon this company's financial performance? Or can I just take an alternative, throw it into a money market account and earn 4% right now? Throw it or invest in the S&P 500, which has historically returned 10%. And that's a diverse 500 company diverse portfolio of publicly traded companies, much safer than investing in a closely held business like this. So a return like that is just, no investor would accept that.
So how far off do you think that 11.4 is?
Well, I think to me, it's the approach that was done was applied against the wrong metric. So if you look at kind of what's been, talked about here, it's almost like a 10-to-1 adjustment if you apply it to the correct metric. So you're talking 85 to 90% off based upon just calculating the differential in revenue that multiple was applied to.
So 10 times wrong.
Right.
I don't have no further questions.
Thank you, Mr. Mather, and thank you, Mr. Seaman. I'm going to see if the Franchise Tax Board has any questions for you. Ms. Kodak, do you have any questions for Mr. Seaman?
No, I have no questions. Thank you.
Okay, thank you. I'm going to move to my panel and ask Judge Vasig, do you have any questions for Mr. Seaman?
I don't have any questions. Thank you, Mr. Seaman.
Thank you.
Thank you. And I'm going to go to Judge Lamb. Do you have any questions for Mr. Seaman?
No questions. Thank you.
Okay, thank you. We really appreciate your time and attention in this matter, Mr. Seaman. I know it's been a long day. We really appreciate everything you've given to us today.
Thank you.
Okay. Mr. Mather, would you like a short recess before we move to arguments? Are you ready to move into your closing argument?
I prefer 5 or 10 minutes if we could have it.
Yeah, let's do 5 minutes. So let's be back at 3:05. Okay, okay, we are returning from recess. I'm making sure everybody's here with us. I have my judges. There we go. And Miss Alonso, are you ready to begin? Okay, we are back on the record and we are moving to appellant's legal arguments. Mr. Mather, are you ready to begin? Oh, I can't hear you. Sorry, I think you're muted.
Oh, okay. All right. I thought I did that. It was doing something different.
No worries. Thank you.
Okay. So, just one thing, Jamie, if you don't want to stay on for the rest, you don't have to. You're excused, I believe. Isn't that correct?
Yes, you are excused, Mr. Seaman. Thank you so much for your time. You don't have to stay if you'd like to leave.
Thank you. Appreciate it.
Thank you.
Thank you. So I started with my opening statement by wondering why we were here, and I still wonder why we were here. Again, I'll go through the issues on the second issue first, the installment gain. The parties seem to agree what the law is, and let's take a look at what the evidence is. As we heard from Mr. Kaufman, this was not really an earn out in the traditional sense. It was an earn up. It was a possible future payment, certainly contingent, based on future events, not based on a payout, based on the historical performance of the business. It was on something that was different. So his statement was, or his testimony was, that he thought that the thing had no value. So if we're looking for a valuation according to the appeal of MR, the only evidence we have in the record of any valuation is Mr. Kaufman's assessment that has zero value at all. If you don't want to accept Mr. Kaufman's statement of a zero value, we also have the value of what was actually paid. That's $3,537,500 that was based on the 1 year period that was applicable for the potential payment. So those are the only two pieces of evidence we have in the record. The other thing we have in the record is we have this pie in the sky cap on what it could possibly be. That's no kind of valuation that anybody believed in. But the Franchise Tax Board, in spite of the language in the appeal of Amar, which says that if you don't have a great valuation as of the date, then the actual payments are good evidence of what the value is. In spite of that, this case that the Franchise Tax Board supposedly has adopted, as they said in the pre-hearing conference, they're still sticking with 8 million, which is just nonsense. It's gibberish. So maybe it's 3.5 million, maybe it's zero, it's not 8 million. There's not even a colorable claim to 8 million. Okay, so the second issue then is the built-in gain issue that we spent most of the testimony on. And critically, again, what we have is that we have the entire Franchise Tax Board determination based on the ARCSIS report, where the guy that authored the report wouldn't even come here to defend it. So FTB couldn't get him here, couldn't get anybody here. We have been making these arguments since our reply brief 18 months ago, and still nothing. So as I said before, I think FTB has abandoned the determination by the failure to put on any credible evidence whatsoever, certainly not entitled to any presumption of correctness based on this piece of paper that nobody thinks has any credibility whatsoever. And why is that? Well, because as the evidence showed, we have it, the author of the report is a CPA, a forensic accountant with a part-time appraisal designation that's the author of the report. He used a revenue-basis formula when the entire industry uses EBITDA. Not only the travel industry, but basically any type of valuation of a business from an investment standpoint is based on EBITDA. And why is that? Because that determines how quickly you're going to get your money back. Revenue determines nothing. It could have a correlation. In this case, he didn't prove a correlation. He used the wrong amount for the revenue. He used the gross bookings, the air sales, I think, as Mr. Kaufman referred to it, not the agency's actual gross revenue. And that alone reconciles the ARCSIS report with our report, because as everybody testified, the ARCSIS report is off by at least a multiple of 10, and the difference between the air sales and the gross revenue of the agency is a multiple of 10. So if you eliminate that single error, then you get to the point where ARCSIS and the 4 bits of appraisal information that we have are basically within a very reasonable range. So wrong number, wrong method. He used the MVIC factor, which from his sample of 12 transactions over a 10-year period in which there were probably 70,000 transactions, if I got my math right, 700 a year for 10 years, 7,000, sorry. 7,000 transactions, he finds 12 and comes up with an MVIC as his real indicator of value that has a range from 0.04 to 0.83, a range of 20 times. So not an indicator that has any high degree of correlation to the values from his own sample. And he doesn't do any kind of analysis to say why that is. He just picks a number and applies it to the wrong revenue item. He also, as was highlighted certainly by Jamie Seaman, absolutely ignored 5 years of earnings history, reported and incorporated in his report, reported in the Marshall and Stevens in Exhibit 3 to their report. 5 years of earning history he ignores entirely, and so therefore has no check on his wild conclusion of 11.4 million of enterprise value. So, and finally, as was made, I think the point was made by every one of the witnesses here, who pays $11 million for a business that earns $287,000? Nobody. Nobody pays that. Nobody pays anything near that. Nobody pays 1.4 million for that, much less 11.4 million. It's just an absurd piece of garbage that can't support anything in this case. And we've been fighting against this for years with the Franchise Tax Board hanging on to, I guess, the burden of proof, which they are absolutely cannot be entitled to in this case when it's so clear that the entire basis of the determination is just a complete fabrication. So what is the evidence in the case? So, well, we've got evidence from 4 witnesses, essentially counting Jocelyn, but if you don't count Jocelyn because he's retired and is not here, 3 live witnesses that said EBITDA is what drives the valuation of a service business, and specifically 2 extremely qualified industry experts that says in the travel agency, it's basically the foundation of the negotiation. You know, ARCSIS didn't see it worthy to even test their assumption with, but that's what the market is. It's like saying I'm appraising the market value without looking at the market. But we can look at the market. We have Sweeney, we have Kaufman, and we have Seaman that all said EBITDA is the driving force. We have EBITDA. We have in Exhibit 3 to the Marshall and Stevens report, we have $287,121. There's no serious question that that's the real EBITDA number. It was applied basically by everyone, and it was very consistent with the 5-year trend for the business and the the typical amount of EBITDA based on the volume of real sales from this agency. So we've got the EBITDA, then we've got multiple witnesses basically testifying to a EBITDA multiple of 2.5 to 6 times. Sweeney says 2.5 to 6 times exactly. Kaufman said maybe in a very large, very large agency, it could go higher, maybe as high as 8 or 9, but almost all of the transactions are 6 or less. And we have Seaman, who used 5 based on comparable sales and 5.9 based on an analysis of publicly held companies. So everybody, all the evidence, all the credible evidence in this case is an EBITDA of 6 or less. And we've got Arxis with an EBITDA of 40. So also, the other adjustment is if you look at the Marshall and Stevens report in Exhibit B, we spent some time on page 36, the balance sheet items. The EBITDA multiple determines the enterprise value. The balance sheet items vary from company to company and need to be adjusted out. That's what Marshall and Stevens does. So that's nobody's really contesting the adjustments for the balance sheet items. So what we're left with is Marshall and Stevens has a $710,000 valuation based on industry standards confirmed by experts in the industry, experts in transactions in the industry. He has impeccable professional qualifications, not a part-time CPA. He's independent, analytical. It's tested it 3 different ways to determine that the conclusion was appropriate. And as I said, backed up by Sweeney, Kaufman, and Jocelyn, all 3 of those additional sources of detailed industry expertise confirming the Marshall and Stevens report. So what we have from the Franchise Tax Board is nothing. We have absolutely nothing credible other than, well, maybe it was this, could have been that. We found this ridiculous Arxis appraisal to be the most appropriate means, quite clearly because it was 10 times anything realistic, and that supported a better adjustment. But there's nothing, the actual evidence, if Arxis had come in and explained these seemingly glaring errors in the report, maybe we'd have something. We're left with nothing on the side of the Franchise Tax Board and nothing to sustain that determination. That concludes my remarks.
Thank you. Thank you, Mr. Mather. I'm gonna see if my panel have any questions for you before we move forward. Judge Vasig, do you have any questions?
I don't have any questions at this time. Thank you.
And Judge Lamb, do you have any questions?
No questions at this time. Thank you.
Okay, Mr. Mather, you will have a period for a final statement after FTB's presentation, just to forewarn you. Moving to the argument for the Franchise Tax Board. Ms. Kudik, are you ready to begin your presentation?
Yes.
Thank you.
Okay, I'm going to start with the facts. In July 2007, PTG purchased Ambassador for $2.52 million, increasing PTG's yearly sales by $29 million. On August 17, Jocelyn estimated PTG's selling price at $1.9 million in an asset sale and $740,000 in a stock sale. On November 1st, PTG converted from a C corporation to an S corporation. 5 years later, on November 1st, 2014, Direct Travel bought PTG for $25.3 million, with one contingent payment made in 2016. Per the sales agreement, up to $8 million of the sales price was designated as an earnout based on gross income for a period ending in 2016. As part of the sale, appellants made an Internal Revenue Code Section 338H10 election, which designated the sale as an asset sale. Further, Section 7.4I of the sales agreement obligated Direct Travel to pay any tax liability associated with the Section 338H10 election and the built-in gain. No built-in gain was reported by PTG nor Direct Travel. In 2015, Marshall valued PTG's fair market value at $710,000 as of November 1st, 2009. The Marshall valuation was prepared for John Kaufman, who is the CFO of Direct Travel. In 2019, Arxis valued PTG's fair market value at $9 million as of November 1st, 2009. Respondents' determination of a deficiency is presumed correct. Appellants have the burden to prove that Arxis valuation, which respondent used to prepare the proposed tax assessment, is erroneous. Appellants haven't met that burden. Both issues in this case depend on fair market value. As we heard previously, fair market value is defined as the price at which property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell. Both parties have reasonable knowledge of the facts. Courts have determined that fair market value is a question of fact. Fair market value doesn't substitute for debt. It doesn't subtract for debt. Fair market value is the value of that it will be sold for in an open market. You can't have two fair market value determinations based on the structure of a deal. There's one fair market valuation. Using the factors of Revenue Ruling 3960, there are three approaches to valuation, which we've heard before. There's the income approach, which uses the present value of the business's future income stream, the net asset value approach, which aggregates the net value of the assets of the business at a fixed point in time, and the market approach, which compares the company to an arm's length transaction involving sales of similar corporations or its own sales. Arxis relied on the market approach, using sales of comparable companies and PTG's 2007 purchase of Ambassador. Marshall used an income/market approach based on net income, but Arxis noted that Marshall did not adjust for net income for non-operating income and expenses, non-reoccurring income and expenses, related party transactions, and most importantly, owner-officer compensation. Also, Arxis stated that Marshall did not properly account for the acquisition of Ambassador or intangible assets. So the first issue in this appeal is the built-in gain. And the built-in gain is calculated by subtracting the basis from PTG's fair market value on November 1st, 2009, the date of its S-Corp election. For 2014, California law requires an S-Corporation to pay C-Corporation tax rates on any gain recognized within 10 years of the S-Corp election. Appellants did not report any built-in gain, but now acknowledge that their built-in gain is taxable. However, appellants dispute the correct amount of the built-in gain. Section 7.4I of the sales agreement requires Direct Travel to pay any tax liability associated with built-in gain and associated with the 338H10 election. So at issue in this appeal is PTG's fair market value on November 1st, 2009, and the correct amount of built-in gain. So as we've heard all afternoon, appellants present two reports. The first is the Jocelyn report, which is not a valuation of fair market value, but an estimated selling price of an undetermined date. The Jocelyn estimates PTG's selling price at $1.95 million in an asset sale, and here PTG made a 338H10 election, which treated the sale as if PTG sold the assets to Direct Travel, then liquidated, distributing the proceeds to PTG's shareholders. This was done so Direct Travel could get the corresponding depreciation. At a minimum, this report gives PTG an estimated selling price of $1.95 $745 million, not $745,000. A price discounted for a stock sale, which does not address the facts of this appeal in which a 338H10 election was made. Further, the Jocelyn report was done in August 2008. PTG bought Ambassador for $2.52 million a year earlier. This report does not address the value of those assets, nor the $29 million increase in PTG's sales. The second report is the Marshall report. The Marshall report provided a fair market value opinion of $710,000 for PTG as of November 1st, 2009. Again, according to ARCSIS, this valuation failed to normalize net income for non-operating income and expenses, non-reoccurring income and expenses, related party transactions, and owner-operated compensation. As Mr. Sweeney said, EBITDA can be compressed, presumably because the cash has been taken out of the company for compensation. The accuracy of evaluation depends on the validity of the assumptions used in the calculations. Here, ARCSIS stated that Marshall's assumptions were faulty, as Marshall's valuations did not account for profit-taking, which compressed net sales. The valuation did not consider the acquisition of Ambassador, and the valuation did not properly account for intangible assets or goodwill. Mr. Kaufman said the costs deviate in a company, but here ARCSIS says the valuations do not account for these deviations. Appellant's valuations were also inconsistent with the net asset value approach. In 2009, PTG's assets totaled $3.6 million. Long-term debt was $2.4 million. So using the net asset approach, ARCSIS noted that PTG's values would be at least $1.2 million. Using this valuation method, PTG would be valued at least $500,000 more than appellants allege, but in line with the $1.95 million expected sale price stated in the Jocelyn report. The third valuation type is the market approach. ARCSIS relied on the market approach using the sale of comparable companies to value PTG. Respondent found that ARCSIS valuation of $9 million was the better valuation because it relied on data from comparable transactions, 12 in all, and emphasized the amount PTG paid for Ambassador in 2007. ARCSIS also used market value of invested capital, MVIC, which respondent found more accurately valued PTG because it included business, intangible assets, and goodwill. Further, applying MVIC to the purchase of PTG in 2014 yields an MVIC to sales ratio of 15%. This is comparable to the ratios used by ARCSIC in valuing PTG on November 1st, 2009. In contrast, Marshall applied an industry-based multiple to pre-tax cash flows. This method discounts the value of PTG improperly, according to ARCSIS, because it does not account for the increased expenses and salaries as revenues increased. Further, the ARCSIS valuation was more representative of what PTG actually sold for in 2014 and the value of the assets PTG bought in 2007. An arm's length sale relatively close in time may be indicative of fair market value of a closely held company. 5 years after the 2009 valuation, Direct Travel bought PTG for $25.3 million, bolstering the credibility of ARCSIS valuation of $9 million as of November 1st, 2009. Given these facts, it was respondents' determination that the valuation of $9 million was the more accurate estimate. The second issue in the appeal is the correct amount of tax to be paid on the $8 million earnout payment. And I think I want to take this moment to explain that I think appellants misunderstand what's taxable in this second issue. They say that Kaufman has valued the earnout payment at zero. They say they got $3.5 million in 2016, but the actual amount that's taxable is a 2014 value. That's when the fair market value of the contingent payment needs to be made. And I understand that appellants also say that that is not in line with the precedential case of appeal of Amar. However, that's incorrect, because if you read footnote 17 of the appeal of Amar, it specifically says what at issue in the appeal of Amar is not the fair market value, but when the taxes should be paid. And the valuation of the contingent payment was yet to be determined. So in this appeal, that is what it's issue. What amount do we use for the fair market value of the contingent payment? So respondent's position is that it's the $8 million maximum sales price listed in the sales agreement, and that's the fair market value of the earnout as of November 1st, 2014. Appellants assert it's the 3.5 million, then they assert it's zero. I'm not really quite sure what their position is. Appellants elected to treat the stock sale as an asset sale per section 338H10. Appellant's election means that all of PTG's assets were sold on November 1st, 2014, and the proceeds were deemed sale of their assets were treated as a distribution to the shareholders of PTG. The contingent payment obligation is included in that distribution. Therefore, the $3.5 million received in 2016 is irrelevant. Also, an expert's opinion in 2024 is also irrelevant. Appellants have the burden to show that the fair market value of the contingent payment obligation on November 1st, 2014. They have not met that burden. Again, Mr. Kaufman's testimony on the mechanics of the earnout and how much it could be valued is irrelevant. Appellants needed to have a fair market valuation of that contingent sale obligation as of 2014 when they distributed it to their shareholders. That's the transaction that's being taxed. The gain recognized on the deemed distribution is the difference between the fair market value of the contingent payment obligation and the basis in that obligation on the date of the deemed sale. Payments received after the close of the year in which a disposition of assets occurs are taxed per Internal Revenue Code Section 453C as installment payments. California conforms to Section 453C. Contingent payments are taxed as installment payments. I'm sorry, this is going to be long. Treasury Regulation Section 1.338H10-1 subsection D8 states that in the case of an installment sale, the corporation is treated as distributing the installment obligation to the shareholders in exchange for their recently sold stock. The gain recognized on the distribution of the contingent payment obligation to the shareholders is what's taxed in this appeal. Per California Revenue and Taxation Code, Section 24672, the unrecognized income of installment obligations held by a corporation must be recognized in the corporation's final year, and that is subject to tax. Because PTG filed its final tax return in 2014, it must report the gain realized on the deemed sale of assets in 2014. According to Amar, the unreported income is the difference between the fair market value of the contingent payment obligation at the time of distribution and the basis in the obligation. Again, as I said before, the question in this appeal is whether the fair market value of the contingent payment obligation is $8 million, which is the maximum selling price stated on the sales agreement. Absent any evidence from appellants to the contrary, such as a valuation report, respondent can only assume the maximum selling price is the fair market value. Additionally, there's regulatory guidance that the maximum selling price would be treated as the fair market value for purposes of recovering basis when applying this installment method. And appellants have stated on their 3805E form that the sale was valued at $23.5 million, using a fair market value of $8 million for their contingent payment obligation. Valuation is an estimate. Courts tell us that an actual arm's length sale in the normal course of business within a reasonable time before or after the valuation date is the best evidence of fair market value because it shows the actual value of the company. Here, 5 years from the date of valuation, Direct Travel bought PTG for $23.5 million. And 1 year earlier, PTG bought Ambassador for $2.52 million. Further, the fair market value of the contingent payment is $8 million because appellants have provided no evidence to the contrary. They have not met their burden of proof. In conclusion, appellants bear the burden of proof to show that respondent's deficiency and in turn its valuations are in error. Appellants have not met that burden. Respondent properly proposed a tax adjustment to include built-in gain from the sale of PTG's assets and from the distribution of the contingent payment obligation. So respondent's notice of assessment should be upheld. Thank you.
Thank you. I'm going to check with my panel to see if there are any questions for you, starting with Judge Vasig.
You have a question for Ms. Kudet. You did talk about this. I just would like to ask you to clarify for us. Is it FTB's position that the relevant law precludes reliance on EBITDA as valuation method?
I'm so sorry, you're glitching in and out. Can you say that again?
Mhm.
Okay, thank you.
Okay, I just wanted to clarify. Is it FTB's position that the relevant law precludes the use of EBITDA as a valuation method in this case?
When you say relevant law, what law would that be?
You discussed the valuation methods that FTB looked at, and I'm just wondering if you're saying that EBITDA cannot be considered a reliable valuation method.
Oh, because of a revenue ruling 5960?
Mhm.
Oh, I see what you're saying. I would have to confer with my co-counsel. Is that a problem?
Judge Hosey, can we give FTB a few moments?
Okay.
Let's, do you want 5 minutes?
Yeah, he's not in the same room as I am, so I'm gonna have to call him. Sorry. Yeah.
Okay, let's take a quick 5-minute break, and then that will be, what is it, 3:45? We'll reconvene.
Okay, thank you.
So let's just turn
Thank
off
you,
our
Judge
cameras
Hosey.
and microphone. Yeah, we'll see you all in 5 minutes. Okay, we are returning from a recess and we are back on the record. Wait, let me just check with Miss Alonso. Okay, we are back on the record. We're returning to respondent, Franchise Tax Board. Ms. Kudik, did you have a response? Oh, Ms. Kudik, are you there? Can you hear me?
Mhm.
Okay.
Yeah.
Did you have a response?
I'm gonna,
Judge,
I'm gonna hand you off to my co-counsel.
Oh, okay.
Judge, if I understand your question correctly, the Franchise Tax Board is not taking the position that EBITDA cannot be used as a valuation methodology. Okay, our position is that based on what our expert told us about the other reports, we found it to be unreliable in this instance.
Thank you for clarifying that.
You're welcome, Judge.
I do want to ask a follow-up question because it sounds like from appellant's experts that EBITDA is kind of the standard for evaluation in this particular industry. So I want to know if the Arxis evaluator, I saw his CV in the exhibits, does he have experience with this type of industry? Maybe not travel agencies specifically, but similar industries.
Can I take that one also, Addie? You know, we don't, am I still going? Yeah. We don't, I can't tell you for certain because our expert was no longer available to us when Ms. Kudik and I took over handling the case. I will say this, one of the things that sort of what impressed me about our own expert's report was the fact that he relied upon 12 sales of travel companies in reaching his conclusions. And while appellant's counsel seems to think that's a small number, given the thousands of supposed sales out there during this time period, we noted that their own expert relied on only 2 sales. Interestingly enough, one of the sales relied upon by appellant's expert is also one of the 12 sales that our own expert relied on. So I think appellant's counsel also said something, one or more of them said something to the effect that the techniques or methodologies used can be used across various types of industries. So I would say, you know, whether or not our expert was steeped in valuing travel agencies, he used similar methodologies, or at least in the general sense of a market methodology, and used a much more numerous number of comparables. So I guess that doesn't directly answer your question other than we can't really say because our expert isn't available to us anymore. Thank you, Judge.
Thank you, Mr. Kriegel. I have no further questions at this time.
Thank you. I'm going to move it to Judge Lamb. Do you have any questions for respondent Franchise Tax Board?
No questions, thank you.
Okay, thank you. Let's move on to appellant. Would you like time for a rebuttal or final statement, Mr. Mather?
No, I can go.
Okay, go ahead when ready.
So the FTB quoted a number of things that are supposedly facts in the case, and there's a litany of incorrect assertions in that. The first one was that the Ambassador transaction added $29 million of sales. That is not a fact. It is an assumed fact that came from the Arxis appraisal report on page 7 of Exhibit C. So it's not a real number. It's an assumed number based on multiple assumptions. So not true. The FTB repeatedly talks about the 20-something million sale. Not true. it's a $15 million sale based on the current state of the company and an $8 million earn up, as we heard from Mr. Kaufman, that could have had value or could have not had value. He believed it not to have value. That's evidence in the record. He's established with familiarity in this transaction, as well as familiarity with over 150 transactions, not counting the 200 transactions that he wasn't able to close, that he understands how these processes work. So his testimony is not nothing. It is what is nothing is what the Franchise Tax Board has presented to us in this case. Another assertion that was repeated in a couple of different contexts is that the fair market value of the business for the purpose of our built-in gain computation I think they said didn't include the asset reduction for asset values. That's simply incorrect. It's the fair market value of the business. It's not the gross value of the assets that matters. And that is also in the Jocelyn report, the debt load of the company is what accounts for, as Mr. Kaufman said, the difference between the value of the company and the value of the assets, or the estimated value of the enterprise based on an earnings multiple. The FTB repeated again the kind of ridiculous assertion from the ARCSIS report that because there could have been a few dollars here and there for non-operating assets or expenses for this and that or the other that should be adjusted, that we should disregard the sole method that's really reliable for valuing these and come up with the ridiculous assumptions applied by the ARCSIS appraisal using the wrong method on the wrong numbers. So these, as Mr. Kaufman testified, businesses, travel agencies have almost no non-operating income, almost no non-operating assets. They have to be lean to survive because they're working on a very small margin. Again, the Franchise Tax Board says, oh, well, we didn't account for the net asset value method of appraising a company. As was made clear by everybody, that's not an appropriate valuation method for a service business that has no assets. So this is a business that generates income. There was detailed testimony how there's really no assets. There's rent. There's 70% of the expense is payroll. So I don't know how the net asset value of payroll would be computed. It's clearly an irrelevant statistic, and even suggesting it shows that the Franchise Tax Board doesn't really understand the valuation issues on this issue yet. Mr. Craigle indicated that there were only two comparables in the Marshall and Stevens valuation method. That is two comparables on one component of three methods of valuation. There was also the public company method, which determined an EBITDA multiple based on public companies, and of course, again, for the umpteenth time, the ARCSIS guy used these 12 transactions that had partial information. He used bits and pieces, using a factor that had a wild range of results that had incomplete information and based on the wrong sales number. So with respect to the installment gain issue, I'm not sure that I followed that litany of citations, but I think the rule is pretty simple. The rule is that because of the 338H10 election, we have to include the value as FTB conceded, the value of the earn up agreement as of the date of the transaction. Mr. Kaufman again testified it was zero, and the appeal of Amar case clearly states, and it's just ignoring what part of the holding in that case is, clearly states that in the absence, if you find Mr. Kaufman's evidence to be not credible of the zero value, then it's reasonable to look at what the payments are. And the payments are 3.5. The 8 is a meaningless number. We get hit with this $8 million, which was a cap, not a number, not any kind of determination of what value was. It was a cap, and it comes back to us in two ways. It comes back as somehow being evidence of value of the earn up agreement, which it's not, and it comes in as an extra $8 million on the purchase price because the sale was 15 million. The sale, based on the historical, the status of the business at the time, the sale was $15 million. You only get into the 20s by adding in the 8 million, which is not a number that was part of the sale. It was just it was a cap on the potential future payments under the earn up agreement. So nothing in the FTB's presentation can change the result. That they've offered no evidence. I appreciate the fact that they didn't bring in the Arxis guy. As I mentioned before, he's still alive. He's still in business. I don't know why he's not here, other than he didn't want to try to defend this piece of garbage that the FTB is saying is the basis of the determination and the reason they should have the burden of proof, which is absolutely nonsensical. If they don't want to bring in the Arxis guy or somebody that's going to say the same thing, and that is the sole basis of the determination, they are not entitled to the presumption on the burden of proof. The burden of proof is not an absolute rule that whatever number FTB gets some yahoo to come up with that they can pull out of the air means that you have to ignore everything else in the record in the case. You have to ignore the experts, the travel experts, the people involved in the transaction, and all these different people. They count for nothing, but this guy who isn't even here and has a report riddled with ridiculous assertions, that's what sustains the burden of proof for the Franchise Tax Board, because everything else is useless. And that's just that. I mean, why don't we just make the rule that whatever the FTB determines is the result? Because that's essentially what they're asking us to do in this case. That concludes my remarks.
Okay, thank you. I'm going to see if my panel has any other questions. Judge Vasig, any other questions for the parties?
Do I get
Have
to
any
respond to that?
questions?
I'm sorry.
Do I get to respond to that, or is that, or is my
Would you like to?
presentation- Oh, I think I would. Yes.
We have about 20 minutes. I mean, I'll give you 5 minutes if you'd like to respond.
Well,
And then
she's not
I'll-
supposed to get a response, but I would
Well,
like
you'd get
a
a final response. Yeah, you would get an opportunity to respond to her response if you'd like to.
Okay. There's
Ms.
a
Kidda, go
couple
ahead.
things- Yeah, it might take me a little bit of time to find them in the exhibits, but off the top of my head, we did ask for a continuance to have our expert here, and we were not granted that. So I don't think it's fair that appellants are making an argument that our case is less credible because our expert wasn't here. I mean, we can't control schedules. So we did make the proper, petition to the court to have him here. Secondly, I'd like to read the part of Amar, footnote 17, which does say, so in Amar, the OTA did rule that the amount received was the fair market value, but there was a reason for that. And the reason was that this was a refund claim. And in footnote 17, OTA said, we note that the maximum sales price may result in a conclusion that more tax is due, whereas we are only deciding whether appellants are entitled to a refund based on FTB's determination of the gain. And FTB made that determination because it was a refund claim. This is not a refund claim. So what's at issue here is what is the fair market value? And the fair market value typically would be the value in 2014, not what's received years later. My third thing I would like to say is that I know the 3805E form is in the record in multiple places. If you want me to find it, I can, but I would just like to point out that in the 2014 sale, $5.44 million of property was actually sold. So PTG was an asset-based company too. It held at least $5.4 million of real property. So when appellant was saying that this was not a company that had actual hard assets, they actually did. And those are the only points I would just like to refute.
Okay, thank you. And I'll go ahead and move it over to Mr. Mather if you'd like for an opportunity for a final response.
All right. With respect to the unavailability of FTB's expert, if you recall, Your Honor, FTB said at the pre-hearing conference that they didn't think that expert would ever be available. So, and apart from that, as we pointed out before in the objection to the deferral request, that we've made these arguments 18 months ago, and FTB, if they don't have somebody here now, I believe that they'll never come up with somebody. And certainly they're not going to come up with anybody that comes up with a number like the ARCSIS report, because it's just unjustifiable. The distinction on the appeal of Amar, I completely flew over my head. I don't know why, if the issue is the application of the statute, it matters if it's a refund case or a deficiency case. It's inconceivable to me that could be a distinction of any consequence. I think you're trying to determine what the right result is. And those are the only remarks I have.
Okay, thank you. I appreciate it. I know we could probably go back and forth forever, but I'm going to see if my panel has any final questions for the parties, starting with Judge Basig.
I have no further questions for the parties. Thank you.
Thank you. And Judge Lamb?
No questions, thank you.
Thank you. All right, are there any questions that I can answer from the parties before we submit the case today?
Nothing from appellant.
Okay. We are ready to submit the case. The evidence has been admitted into the record, and we have the arguments in your briefs, as well as the testimony and oral arguments you presented today. We now have a complete record from which to base a decision. We are ready to submit the case, and the record is now closed. This concludes the hearing for this appeal. The panel will meet and decide the case, and the parties should expect our written opinion no later than 100 days from today. I wish to thank both parties and all the participants today for their time and efforts in this matter. And with that, we are off the record, and the hearing is now adjourned. Thank you, everyone.
Thank you.